Okay, hello everyone. Now, in today's class, we are going to attempt September-December 2024 past paper. So the question number one is in front of me. Let's start. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Northney Group. Northney Company is a commercial vehicle manufacturer based in US. So Northney is a commercial vehicle manufacturer based in US, currency is USD. It has continuously enhanced the use of automation and information technology in its operations. The reliability of its vehicles is high due to strict quality control procedures which it enforces. Northney's head office and group functions such as treasury and internal audit are based in the United States. However, over time, Northney established a number of subsidiaries in Europe which carry out production and sales activities. Apethorpe, its UK, currency GBP. Flexcom, its Eurozone, currency Euro. And Pamber, Denmark, currency DKK. Northney is looking to expand its presence beyond North America and Europe, and its sales outside these continents are increasing. So what did we learn? Northney is a commercial vehicle manufacturer based in US. It has continuously enhanced the use of automation and IT in its operations. Reliability of vehicles is high due to strict quality control procedures. Head office and group functions such as treasury and internal audit are based in US. However, over time, Northney has established a number of subsidiaries in Europe which carry out production and sales activities. Apethorpe is in UK, Flexcom in Eurozone, and Pamber in Denmark. Northney is looking to expand presence beyond North America, Europe. Its sales outside these functions is increasing. Treasury function. Northney's group treasury function is involved in setting the group's overall financial objectives. It provides currency and interest rate risk management and corporate finance services for the group as a whole. Also deals with other treasury activities of the parent company. The group treasury function is currently based at the head office in US and overseen by the group finance director. Staff work full-time in the group treasury function office. Okay. In addition, each subsidiary has its own treasury function responsible primarily for liquidity and funding management. Because more of the Northeast Group activities taking place in Europe, the group finance director has made a proposal to relocate the group's treasury function to Europe. Separate treasury function would be established in US, responsible for liquidity funding management of the parent company. Because operations are increasing, group director has made a proposal to relocate treasury function to Europe. Treasury activities. In order to increase the director's understanding of treasury activities, a report is to be prepared which will include appendix giving examples of intra-group netting between Northney and subsidiaries, hedging foreign exchange risk using futures, hedging interest rate risk using collar, together with an explanation of why futures and collars will have been chosen to hedge the transactions concerned. So this is very, very detailed thing that Northney is a commercial vehicle manufacturing company based in US. USD is the currency. It has subsidiaries in UK, Denmark, and Europe. Treasury functions information is given that it's currently in US, but they're planning to shift it to Europe. Treasury activities, and in order to increase the director's understanding of treasury activities, report is to be prepared, which will include appendix giving examples of intra-group netting between Northrend subsidiaries, hedging foreign exchange risk using futures, and hedging interest rate risk using collar, together with explanation of why futures and collars will have been chosen. Intra-group netting, second exhibit. Cash flows between Northney and a group of companies are managed through intra-group netting using USD as the base currency and spot mid rates. Okay. The following cash flows are owed by and owed to. Owed by is payable, owed to Northney, USA to top, GBP 16.4, USA to Euro 37.42 million euros, UK to Euro 40.75, UK to Denmark, DKK 82.2. All transactions are given and the spot mid rates are given. Okay. Euro 0.9627 equals to USD 1. So I've taught you 1 is denominator. So it's USD in denominator here. So it's an indirect quote. Okay. And a euro in denominator, it's an indirect quote. Okay. So always remember 1 always means denominator. Settlement will be made in the order that company owning the largest amount in USD will settle first with the company owed the smallest amount in USD. So settlement will be made in order. Company owing the largest USD will settle first with the company with the small USD. Futures hedging. It is now 1st September. A Japanese company owes Northney JPY 925. Japanese company owes you. That means you have to receive. A Japanese company owes Northney. So we have to receive it from Japanese company JPY 925 million for a sale which has just been agreed. Settlement of the contract is due on 1st May. Today is 1st September. It's due on 1st May. So 1st October, 1st November, 1st December, 1st January, 1st February, 1st March, 1st April, 1st May. It's after 7 months. Okay. Now 1st September, you're expecting amount on 1st May. So 1st October, 1st November, 1st December, 1st January, 1st February, 1st March, 1st April, 1st May. Sorry, 8 months. Sorry. 1st October, 1st November, 1st December, 1st January, 1st February, 1st March, 1st April, 1st May, 8 months. Group treasury function decided to use futures. So it's USD to JPY. Since you are in USA, USD numerator, it's a direct quote. Spot trade is given. Futures contract size is JPY 12.5, quoted as USD to JPY, USD numerator, it's a direct quote for 30th September, 30th December, 30th March, 30th June are given. Okay. Today is 1st September. This is for 30th September. You remember, it's always at the end of 30th September. So it's after 1 month. This is 30th December. So 1st October, 1st November, 1st December, 30th September. This is 4 month. Then this is March, this is June. I will count the months. Future contracts mature at the month's end basis can be assumed to diminish to zero at contract maturity at constant rate based on monthly intervals. It is also assumed there is no basis risk, no margin requirements. Callers. It is now 1st September. On 1st February, Northney is due to receive an amount of USD 54 million, which it plans to invest until the funds are likely to be needed on 1st August. It is now 1st September. On 1st February, you will receive amount of 54 million. So it is 1st September, 1st October, 1st November, 1st December, 1st January, 1st February. 1st October, 1st December, 1st January, 1st February. It is now 1st September. You are expecting to receive 54 on 1st February. So till 1st October, it's 1 month. 1st November, 1st December, 1st January, 1st February. 5 months. You are planning to invest it until funds are needed on 1st August. So you are planning to invest it from 1st February to 1st August. So 1st March, 1st April, 1st May, 1st June, 1st July, 1st August. You are investing for 6 months. Base rate is 3.25 and prediction in the media suggests it could rise or fall by 0.5% on 1st Feb. Don't confuse the dates. I will solve them later in writing once I'm doing the question. Northree can currently invest funds at a floating of base rate minus 30 basis points. Group treasury function decided to use a collar on options on interest rate futures to hedge the interest rate risk on short-term investments. Options, USD futures, contract size, USD, premiums are in percentage, 2 strike prices, call puts are given. 3-month USD future price for March futures is 96.54. Okay. And futures and options contracts are assumed to be settled at the end of each month. Basis is assumed to diminish to zero based on monthly comment. There is no basis risk. Okay. Last, new subsidiary. Northney is considering setting up first subsidiary with sales and production facilities outside the US and Europe. So Northney is considering setting up its first subsidiary with sales and production facilities outside US and Europe. Group finance director suggested a country in which subsidiary could be based. The country has low corporate tax rates, which are sustained by an increasing level of government borrowing. It has also limited employment and workplace regulation. It does, however, have regulations relating to workforce of subsidiaries of foreign parent companies. At least 75% of employees of these companies must be home country citizens. So Northree is considering setting up first subsidiary with sales and production facilities outside US and Europe. So now you are in US, Europe, you're going outside US, Europe. Finance director suggested a country. It has low tax rates, government borrowing is there. Regulations say that 75% employees must be home country citizens. The country recently decided not to join a regional free trade area which neighboring countries have established. It is currently in dispute with the regional free trade area. So there is a dispute in free trade area over regulations applied to imports, and it decided not to join a regional free area. One reason for establishing a subsidiary in this country is the demand in the region for robust commercial vehicles for the type which Northree manufactures. These are needed to cope with increasingly changeable weather, including more frequent floods. One reason why we are establishing subsidiary here is demand for commercial vehicles which we are making. They are needed to cope with weather conditions, including more frequent floods. So I have read all these 5. First was for Northree Group, that it's doing netting, then intra-group netting details, then futures detail, then callers detail, and then new subsidiary. Okay, so let's move to the requirements now. 50 marks, scenario 1. So 50-mark requirement usually starts with a report. Prepare a report for board which discusses the issues affecting the establishment of the group treasury function in Europe and impact upon treasury activities relating to European subsidiaries and American parent companies. So for that, I have to read the information in detail, but the report is discuss the issues affecting establishment of group treasury function in Europe and impact upon treasury activities relating to European subsidiaries, American parent. 6 marks. Second, Calculates the impact of undertaking intragroup settlement between an Northrey and three subsidiary companies using a tabular format and intragroup settlement cash flows for four companies. So this is intragroup settlement. Netting requirement 7 marks. Demonstrate how transaction with Japanese customer would be hedged on basis of information supplied. What the result would be hedged. 5 marks. Demonstrates how short-term investments would be hedged on the basis of information supplied on what the result of the hedge would be if interest rates rose or fell by 0.5%. The caller's requirement. Explains why treasury function might have decided to use futures and collar. 4 marks. And says political and operational risks. 10 marks. Okay. Detailed question to requirements. So for the report format, for report to from date subject introduction. Okay, so you all know that how these things are going to function. To prepare a report for board of directors, to board of directors. From, nothing mentioned. Date, I don't have to mention the date. Subject, in report, you have to talk about treasury function, impact of netting, hedging, political operational risk. So subject, Northney's treasury function and hedging issues. Okay, introduction. This report, then all requirements, you know. This report, discusses issues affecting establishment of group treasury function in Europe. It then calculates impact of undertaking intra group settlement between Northney and subsidiary companies. It then demonstrates how transaction with Japanese customer can be hedged. It then demonstrates how short-term investment will be hedged. It then explains It then explains why treasury function may have decided to use futures and collars. Finally, it then assesses political, operational risks which may affect subsidiary under consideration. So I've told you that once you put all these in a report format, then you have to put separate headings for all requirements. And once you find it's a calculation requirement, appendix, theoretical requirement, same here. Okay. So every requirement will now have a heading. The first requirement, issues affecting establishment. Okay. First requirement. Second requirement will have its own heading. Okay. Third requirement will have its own heading. Fourth requirement. Fifth requirement. And the sixth requirement. Okay, so this is a report format that to from date subject introduction. Introduction, this report, all requirements, then finally. And then every requirement will have a separate heading. If it's a calculation requirement, I will write to appendix. Theoretical requirement, write it here. Okay, so please note this so that I can move forward. Okay, now the first requirement is discuss the issues affecting establishment of group treasury function in Europe and impact upon treasury activities relating to European subsidiaries and American parent company. 6 marks. I have to first read what exactly this requirement is, but it's clear that this requirement is a theoretical requirement, so I will write it here. No need to make a separate appendix. Northney is a commercial vehicle manufacturer company based in US. So currently it's based in US. It has continuously enhanced the use of automation and information technology in its operations. Reliability of vehicles is high due to strict quality control procedures which it enforces. Northney's head office and group functions such as treasury and audit are based in US. So treasury function is based in US. However, it has established number of subsidiaries in Europe which carry out production and sales activities. These are the three activities in Europe. Northney is looking to expand its presence beyond North America and Europe as its sales outside these continents is increasing. So looking to expand. Okay. Now, treasury function. Northney's group treasury function is involved in setting group's overall financial objectives. It provides currency, interest rate risk management, corporate finance services for the group as a whole, and also deals with other treasury activities of parent company. The group treasury function is currently based at head office in US, overseen by group finance director. Staff work full-time in group treasury function office. In addition, each subsidiary has its own treasury function responsible for liquidity and funding management. Now, listen what is happening. Northney's group treasury function is involved in setting group's overall financial objectives. It provides currency, interest rate risk management, corporate finance services for group as a whole, and also deals with treasury activities of parent companies. So it provides risk management, currency services for the group. In addition, each subsidiary has its own function. What are the subsidiaries? These are the subsidiaries: Europe, UK, Denmark. Each subsidiary has its own treasury function, but they are responsible for liquidity and funding management. So group treasury function is based at head office. It provides currency, interest risk management for the group as a whole. But each subsidiary has their own treasury function as well. It does not deal with currency and risk management. It deals with liquidity and funding management, how to manage liquidity, how to get funds. Because more of the Northney's activities taking place in Europe, the group finance director has made a proposal to relocate the group treasury function to Europe. Where is the group treasury function? Head office? US. The group finance director wants it to relocate to Europe. A separate treasury function was established in US responsible for liquidity and funding management of parent company. Now, if you don't understand what is happening, then I'm afraid you won't be able to answer the question. What is happening? The group treasury function, which is based in head office, it provides currency and risk management services for the group as a whole. And it deals with treasury activities of parent company. So for the group as a whole, it provides currency and risk management services. Each subsidiary, Europe, Denmark, UK, they also have their own treasury function. They do not deal with risk management and interest. They deal with liquidity and funding management. Now, more activities taking place in Europe. Group finance director makes a proposal to relocate the group treasury function to Europe. Now, if the group treasury function is relocated to Europe, what will happen in USA? Separate treasury function would be established in US. It will be responsible for liquidity and funding management because now the group finance function is at Europe. It will look at currency and risk management from Europe. So separate office will be established in USA just for liquidity and funding. Okay. Requirement is discuss the issues affecting the establishment of group treasury function in Europe. What will be the issues that will affect the establishment of group treasury function in Europe? An impact on treasury activities relating to European subsidiaries and American parent company. So what will be the issues affecting the establishment of group treasury function in Europe? An impact upon treasury activities. Okay. So I just want to mention the issues which will affect the establishment of group treasury function in Europe. At the moment, it's USA. What will be the issues which will affect the group treasury function establishment in Europe? Okay. Since it's a theoretical requirement, I will write the answer here. Now, let's try this answer. Now, what is happening? The group treasury function is basically based in USA. The group treasury function is based in USA. Okay. Overseen by group finance director. Okay. They are thinking to relocate the group treasury function to Europe, and that's what is being asked. What is the issues affecting the establishment of group treasury function in Europe? Now, I want you to think over it. The group treasury function is based in USA head office, and the director is planning to relocate it to head office. What will be the issues? The first issue. cost. If you relocate your treasury function from US head office to Europe, it will lead to cost. Secondly, language skills. If you relocate it there, you might have to hire staff with their language skills. Time zone issues, legal jurisdiction issues. Group head office is relocated to Europe. At the moment, group treasury function is in US and it's led by group finance director. There is one more issue which will be faced, whether the group finance director will also be moved to Europe or here. Since your company's based in USA, just the group treasury function will be relocated to Europe. How will the control be exercised? So these are the issues which affect the establishment of group treasury function. So you can write it. The first issue can be cost, as relocation from USA may incur significant costs. Obviously, you need space. It's the biggest cost. European time zones and legal jurisdictions may also be an issue in establishing treasury function in Europe, as company is based in USA and working hours of USA, where we have head office and working hours of treasury function in Europe may become different. Okay. Language barriers may also be an issue, as we may have to recruit more staff that is local, else remote staff from US needs to be considered. Okay, you're establishing treasury function in Europe. One issue is language barrier. Okay, we may have to recruit more staff that is local. Otherwise, we have to go to remote staff. Group finance director who is currently based in USA, whether he will stay in USA or move to Europe. This is also an issue because it states that the group treasury function is based at head office and overseen by group finance director. So now when treasury function will move towards Europe, whether he will move to Europe. Since parent company in USA how they will exercise control over European function What will be the reporting guidelines? All these issues need to be considered before taking decision to relocate. Okay. So if you know, I have mentioned 5 or 6 points here: cost, time zones, legal jurisdictions, and working hours, language barriers, group financial relocation, parent company in USA, how the reporting will be done. If you want to elaborate, you can elaborate more. Okay. Costs like space costs, you have to find an office there. Time zones, working hours, legal jurisdictions. You're based in USA, you are locating head office in treasury function in, sorry, Europe. What will be the legal jurisdictions? You can elaborate them more as well if you would like. But I have mentioned you 5, 6 points that can come here. And I think this was again not from the book. It was a mark scoring scenario that discussed the issues affecting establishment of group function in Europe. The case was that we were based in USA and our function of treasury was in USA. We were trying to relocate it to Europe. What will be the issues affecting the establishment? This requirement can also come. What issues company must consider before relocation? Same. The company must consider before relocation: time, language barriers, to legal jurisdictions, or issues affecting the establishment. These are the issues affecting the establishment. Okay. Impact upon treasury activities relating to European and American parent company. So I've mentioned the impact on treasury activities as well, that reporting activity, language barriers, these was. So it was just principal requirement. This discuss the issues affecting the establishment of group treasury function. We have solved that. Okay, please copy this. I'm sorry, I need to write one more thing here, that impact upon treasury activities relating to European subsidiaries and American. So what will be the impact on treasury activities? Okay. So you know that currently there is own treasury function in each subsidiary in Europe responsible for liquidity and funding management. So what will be the impact on treasury activities? Now there won't be any each separate subsidiary. Each subsidiary has its own function, which is responsible for primary liquidity and funding management when it moves to Europe. Okay. So the European subsidiary's role will be limited. And again, that will be done by head office. Okay. So the role of this one may be reduced to avoid duplication. Okay. So since at the moment, Europe office has its own subsidiary responsible for liquidity and funding management. If head office is relocated to Europe, this will have an impact on activity of European subsidiary, as their role is likely to be carried out by new head office or head treasury function of Europe to avoid duplication of work. You see, in the scenario, it was nowhere mentioned here that the group treasury function is based at head office, United States. It does currency interest rate risk management, and there was no separate function in US. Why? Because head office was there, all work was done there. But each subsidiary, where were the subsidiaries? These they had own functions for liquidity funding management, but the US one didn't have. Why? Because in US there was head office. Now, when the head office will be relocated to Europe, so European subsidiary, their work will be affected because now head office is there. So they will do the work. So this separate subsidiaries work will need to be reduced to avoid duplication, right? So please copy this so I can move forward. Okay, now what is the next requirement? Calculate the impact of undertaking intra-group settlement between Northney and subsidiary companies using a tabular format, intra-group settlement cash flows. Okay, so this is the same requirement, impact of undertaking intra-group settlement and the settlement cash flows. So in the end, the settlement cash flows do come in a tabular format. 7 marks, okay. There, you know that cash flows are managed through intra-group metering. USD is the base currency. Owed by O2 is given and spot metrics are given. It's a very easy question, but this is a calculation requirement, so I will refer to appendix. Appendix 1 shows impact of undertaking intra-group settlement. Okay, so appendix 2 shows it, so I have to go to the appendix. Let me save them time rather than copying again. Okay, so there are 2 steps in intra-group settlement by netting. First, convert all balances into one currency. So first balance is GBP 16.4 million. Okay. Step 1, all balances USD, one currency. Okay, so GBP 16.4 million. Then Euro 40.75 million, DKK 82.12 million, GBP 56.98 million, DKK 72.68 million, USD 27.29 million. Okay, so 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8. All balances should be converted into USD. Now, it will be multiplied or divide, but in every currency, USD is coming in denominator. So it's an indirect quote. Okay. So 1 means denominator. It's an indirect quote. I've told you that when equals to 1 is written, that currency is in denominator. Okay. So GBP 16.4 divided by the GBP rate is 0.8320. Okay. Euro 37.42 divided by 0.9627. Okay. DKK 82.12, 6.9418. GBP 56.98, 0.8320. DKK 72.68, DKK 6.9418. USD 27.29 remains the same. It's USD, no need to convert. Euro 73.79, 0.9627. All balances have been converted into one single currency, that is US. That's the first step. Now you have to make a table. And the first thing should be step 2 is the owed by. That is payable. Okay. Here it will be owed by. And downside it will be owed to. That is receivable. Okay, so in owed by and owed to, you know that you need to make that format. So I'll make sure we go towards that format first. All things need to be recorded here. So Northney, Ipthorpe. When owed by, it's basically Northney, US. Then it's Ipthorpe, UK. And it's Northney, Flexcombe. So Flexcombe, Euro. And the last one is, sorry, Northney, Ipthorpe, Northney, Flexcombe, Ipthorpe, Flexcombe, Ipthorpe, Pamber. Pamber is UK. Sorry, Pamber is Denmark. I'm sorry. Then Flexcombe, Ipthorpe done. Flexcombe, Pamber done. Pamber, Northney done. Pamber, Flexcombe done. Okay. And all these will come here as well. So owed by and owed to have been recorded, and you all know that once I record these here, it will be a total owed by, that is total of payable, and here will be total of, like here, owed to, that is receivable, right? And then from this total owed by, which will be payable, I will deduct total owed to, receivable. I will get the net payable or receivable. Now, whatever is coming in negative, positive, I will tell it to you. Okay, so let's start it. Okay, let's start it. So first transaction, owed by Northney and owed to Ipthorpe. Owed by Northney to Ipthorpe. How much it is? 19.7115. That is B5. Okay. Second one, owed by Northney here and owed to Fleximborg. Northney Fleximborg. B6. Okay. Then owed by Ipthorpe here, Flexcombe. This. Okay. Fourth, owed by Ipthorpe again. Okay. It's owed by Ipthorpe again. And owed to Pember here. Okay. Then it's owed by Flexcombe and owed to Ipthorpe. Okay. Then it's owed by Flexcombe to Pember. Okay. Owed by Pember to USA. Pember to Flexcombe. Yeah, let me just stop them to 2 decimal places so that it doesn't create a fuss for you. Okay, let's make the total of owed by payables. It's the sum of E15 to E18. Okay, owed to receivable. Here, it's the sum of D15 to, sorry, E15 H15. Okay. Now total of owed by payable is here. Okay, we don't need this total. You'll deduct total of owed to receivable. Okay. So it's Northney, I-15, I-16, I-17, and Pember, I-18. And payable less receivable. Okay, you get the net answer. Payable less receivable. And whatever negative positive will be coming, I will explain you that. So E19, payable less receivable. E20. So some answers are coming in positive, some are coming in negative. Okay. Now, obviously, for Northney, payable is more, receivable is less. So that is net payable. He has to pay. Epthorpe, payable is more. Sorry, payable is less and receivable is more. So it has to receive. So that means receivable is coming in negative and payable is coming in positive. You can only decide it later once you are done with that. Okay. That for here, Norton, payable is more, receivable is less. So it has to pay positive. Here, payable is less, receivable more, it has to receive. Here also, payable is less, receivable is more, it has to receive. Receivable is coming in negative. Here also, payable is more, receivable is less, so you have to pay. So pay is coming in positive and receivable in negative. I'm sure you are clear with this stuff that if you talk about the first one, payable is more, receivable less, payable positive. Here, payable is less, receivable more, so receive negative coming. Here also, payable less, receivable more, receivable more, so receive coming in negative, and payable more, receivable less, it's pay. Okay. Now, who has to pay what? Okay. Let me explain you, and this is written in the question. This means Northney and Pamber have to pay because it's net payable, and Apthorpe and Flexcombe have to receive. Okay, from whom to pay and whom to receive, this has been already told, right? Because this is intragroup settlement, right? These two have to pay. Their payable is more, receivable is less. They have to pay, and others have to receive. So the payables one have to pay to the ones who have to receive. Okay, but how it is going to be settled? Let me just explain it to you further. It's written settlement will be made in the order that the company owing the largest USD, which has to pay the largest USD, will settle first with the company owed the smallest USD. So settlement, it's company's choice. The net summary is that all of these have to pay and receive from each other to settle. But it's company's policy. You may find it in some other question as well, where netting is done. But just to elaborate you that the purpose of netting is that all companies have to deal with each other. These two have to pay and these two have to receive from each other. How it's being done? It's company's choice. Settlement will be made in the order that company owing the largest amount in USD will settle first with the company owed the smallest USD. So this means company owing the largest USD. Who owes the largest USD? Pamber. Pamber owes the largest USD is to pay. Will settle with the company owed the smallest USD. Who is owed the smallest USD? This. So as per settlement order, company owing the largest USD, which is Pamber, will settle first with company owed the smallest USD. And which is owed the smallest USD? Apethorpe. I'm sure you understand the meaning of owed and owing, right? You understand the meaning of owed and owing, right? It is clearly saying settlement will be made in the order that the company owing the largest USD. Owing means I am owing, I have to pay. So the company which has to pay the largest USD will settle first with the company owed. Owed means I have to receive smallest USD. So as per the information, these two have to pay, these two have to receive, they will do from each other. But as per the settlement order, the company owing the largest USD. Who owes the largest USD? Anyone but it owes the largest USD, has to pay the largest USD. Will first settle with the one which is owed the smallest USD. Who is owed the smallest USD? Receive this one. Okay. So I'm sure your netting part is done very clearly. It's a very easy requirement. I have explained you these two statements in detail as well. So you can copy this and then we can move towards the next part. I think we have done with two requirements. The first requirement was of discussion, which I did in Word. And the second requirement was of that netting. So I've done this netting part as well. Okay. So please copy this so that I can move towards the next parts. I've done the discussion part, why establishing or relocating subsidy might be an issue. And the second one, this netting part. Okay. Please copy this. Okay, so we have completed this netting portion, and now we should move towards the next portion now. Okay, now after this netting portion, requirement, I think 1 and 2 have been done. And I'm on the report as well that Appendix 1 shows the impact of undertaking intra-group settlement between Northney and subsidiary companies. Now, what's the requirement 3? Demonstrates how transaction with Japanese customer would be hedged on the basis of information supplied and what result of the hedge would be. So transaction with Japanese customer, this is related to currency futures, right? It is now 1st September. A Japanese company owes Northney JPY 925 million. Japanese company owed Northney. That means Japanese company has to pay us. Okay. This will be a receipt for us. Japanese company owes Northney. Owes Northney means it has to pay Northney 25 million for sale, which has been just agreed. Settlement of contract is 1st May. Group treasury function decided to use futures. This is requirement 3. Demonstrates how transaction with the Japanese customer would be hedged on the basis of information supplied. What result would the hedge be? He has decided to use futures. Rate is USD to JPY. You are in USD. It's a direct quote. Okay. And futures contract size Japanese yen. Future price USD numerator. It's again a direct quote. September 30th, December, March, June 30th. Futures are given. They mature at month end. Basis can be assumed to diminish to 0. And it is also assumed there is no basis risk, no margin requirements. Okay, so requirement 3 is 5 marks, demonstrates how transaction with the Japanese customer would be hedged. So when you read this transaction with the Japanese customer, you know it's a future thing, and in futures only 3 things are required. Okay, the lock-in rate, expected receipts, payments using lock-in rate, and number of contracts. Okay, so first I need to refer to the report. It's a calculation requirement, right? So appendix shows how transaction will be hedged with Japanese customer. You can elaborate it. Currency futures has been used and result of hedge is, well, let's discuss currency futures. So I have taught you the way of doing this, and I would advise you to follow that way. That first, the important thing is the dates. Today is 1st September. Japanese company owes Northney. Northney is our company. Japanese company owes Northney. That means Japanese company has to pay. It is not written Japanese company is owed, else you have to pay. Japanese company owes Northney. Yeah, it has to pay Northney 925 million for sale. Obviously, Japanese company has to pay us for a sale, which has just been agreed. Settlement is due on 1st May. So we will receive 925 million Japanese yen on 1st May. So receipt or payment date 1st May. Okay, so we will receive 925 million on 1st May. If you don't want to write this, you can still calculate. Today's 1st September. We will receive on 1st May. That means 1st September to 1st October, 1 month. 1st November, 1st December, 1st January, 1st February, 1st March, 1st April, 1st May. Okay, so we will receive after 8 months. So this is Appendix 2. About how transaction with Japanese customer will be hedged. Okay. Okay. So the information is that it is 1st September and settlement of the contract is 1st May. So let me count again: 1st September to 1st October, 1st November, 1st December, 1st January, 1st February, 1st March, 1st April, 1st May. We will receive after 8 months. Okay. So exchange rate is USD to JPY. It's a direct quote futures. Now the futures are given for 30th September, 30th December, 30th March, 30th June. This is the futures data given. And it's 0.007408, 0.0008, 0.007453, 0.007496, 0.007538. Okay. Now, I have taught you this in classes as well, that we are not comfortable more with the dates. We are comfortable with how many months are there future. So today is 1st September and the future is given of 30th September. This is 1 month future. Today is 1st September. Future is given of 30th December. To count it 1st September. So 1st October, 1st November, 1st December, 30th December. This is 4 month future. March future is given today is 1st September. So 1st October, 1st November, 1st December, 1st January, 1st February, 1st March, 30th March. 7 month future is given. Okay. And the last month, 1st September today, 30th June future is given. 1st October, 1st November, 1st December, 1st January, 1st February, 1st March, 1st April, 1st May, 1st June, 30th June. 10 month future is given. You know, you have studied these things in the classes as well, that sometimes futures are given like this: 1 month, 4 months, 7 month, 10 month, and sometimes dates are given. So if dates are given, you have to find the number of months to get into a more comfortable zone as we studied. So today is 1st September. We are receiving money on 1st May. So I counted it: 1st October, 1st November, 1st December, 1st January, 1st February, 1st March, 1st April, 1st May. I am receiving after 8 months. Okay. Now futures have been given in 2 month, 3 month, 5 month future. It would have been fine. But it's 30th September, 30th December, 30th March, 30th June. So I counted it that today is 1st September. Future of 30th September is given 30 days, 1 month future. Today's 1st September, future of 30th December is given. So 1st October, 1st November, 1st December, 30th December. Then future of 30th March is given and future of 30th June is given. Okay. Now let's just perform this heading under futures. That the step 1 of futures is to find future lock-in rate, right? You know that you are receiving money after 8 months. So you need an 8 month rate, but 8 month rate is not given, right? So you'll find an 8 month rate. How? You know that 7 month rate is 0.007496 and 10 month rate is 0.007538. Okay, so it's 7.007496 and 7538. The trend is rising, right? Increasing by H27 minus H26. This is a rising trend in 3 months. Per month rising trend, it should be H28 divided by 3. Okay. And now 8 month rate will be found as you have a 7 month rate. What is that? 0.007496. This is a 7-month rate, and it's rising by 0.000014. So if in 7-month rate you add the 1-month rising trend, you will get the 8-month rate as H26 7-month rate plus H30, the rising trend. Okay, 0.00751. Or what you could have done is you could take a 10-month rate and you need 8 months, so deduct the 2 months trend. It's the same thing. This is the future lock-in rate of 8-month. Expected receipts or payments. This is a receipt kit using lock-in rate. Okay, so it's a direct quote. So expected receipts using lock-in rate would be $925 million Japanese yen into 0.00751. So expected receipts would be 925 into 0.00751 because it's a direct cost USD denominator. Million USD. Okay. And then finally, the number of contracts. So number of contracts. The contract size is in Japanese yen and the receipt is also in Japanese yen. You could have directly multiplied. However, if the contract size would have been in USD, I would have taken this USD 6.9475 million and then divided by the contract size. But here it's Japanese yen. So 925 million JPY divided by contract size 12.5 million JPY. You will get the number of contracts as 925 divided by 12.5 million. 74 contracts. So that's it for the futures. So you can write in this word processor that appendix 2 shows transaction we had with Japanese customer and currency future has been used. Result of hedges 6.94675 million USD. Okay. So we all know that in futures, we have to do the same thing that we are receiving after 8 months. We need an 8-month lock-in rate, 7-month rate, and the 10-month rates were given. I made it in months that 1 month, 4 months, 7 months, 10 months rates are given. So I made it in months. 7-month rate, 10-month rate, rising trend per month, 8-month rate, then expected receipts using lock-in rate, and the number of contracts. Okay, please note this. Okay, let's move to the next requirement now. Demonstrate how short-term investment would be hedged on the basis of information provided and what the result of the hedge would be if interest rates rose or fall by 0.5%. So how short-term investment would be hedged on the basis of information supplied, what the result of the hedge would be if interest rates rise or fall by 0.5%. Now, this is relating to exhibit number 4. It is now 1st September. On 1st February, Northney is due to receive an amount of 54 million, which it plans to invest until the funds are likely to be needed on 1st August. Okay. So it is now 1st September. On 1st Feb, it is due to receive an amount of 54 million, which it plans to invest until funds are likely to be needed on 1st August. So we are investing till 1st August. Base rate is 3.25%. Prediction in the media suggests it could rise or fall by 0.5% by 1st February. Northney can currently invest funds at floating rate of base rate minus 30 basis points. Group Treasury function decided to use collar to hedge interest rate risk on short-term investment. Options is given. Contract size $1 million. Premiums are in percentage. Strike price is given for call and put. The middle figures are premium, and this is the strike price given for call and for put. Futures price for March is 96.54. Futures and options contract are assumed to settle at the end of the month. Basis assumed diminishes to zero at contract maturity. Based on monthly time intervals, it is also assumed there is no basis risk and no margin requirements. Okay. So now this is requirement 4 that demonstrate how short-term investment would be hedged on basis of information supplied. So in short, if interest rate increase or fall by 0.5%, you have to do collar working. So obviously, if I have to do collar working, I first need to make the format of collar. It's what you say, calculation requirement. Appendix 3 shows how short-term investment will be hedged. Collar technique is used and result of the hedge is so you have mentioned here that it's related to Appendix 3. So let's start with the interest rate collars. Appendix 3. How short-term investment will be hedged. Okay, now we all know that since in the discussion it's related to collar, so first I have to make the format of collar. The collar format is in the main notes file. Technique of making a collar. Opt for put option at low strike price, call option at high strike price simultaneously. No put and call both are entered simultaneously. And compare exercise price of call and put with future closer price to find gain loss, with premium being differential of both premiums. The only difference here is that premium is the differential of both. Okay, so let's start making the format. And you have to do this working if interest rates rose or fall by 0.5%. Okay, so put call. So, call. Okay, so let's start with put and call. And the first thing is to write exercise price future closeout price future this comes from futures, so the bad news is that you might have to refer to futures for this future closeout price. Then exercise yes, no. gain in basis points? If yes, total gain, right? Excess price, which exercises no gain, basis points versus total gain. Actual cost of borrowing or actual return on deposit. Here, the case is that on 1st February, Northern is due to receive an amount which it plans to invest. So it's actual return on deposit. And finally, the premium payable. So you have to work this out. It's the net premium, right? Differential. Net cost or net return. Here it's net return. And you have to do this working if interest rates decrease by 0.5%. And then you have to do this if interest rates increase by 0.5%. Okay, first if interest rate decrease, or you can do first increase and then decrease. Okay. Now, the bad news here is that previously when you used to do these types of questions in the classes, I used to perform futures, then options, then callers. So all the data from futures and options was given, the gain in basis points and the actual return deposit, you just copy paste it. But here I think you have to work around because future closeout price comes from futures. So I have to work around some future stuff as well. Okay. And for that futures closeout price, I have to see the format of futures. Is the format of futures that first I need to find in futures the number of contracts, right? Then basis risk, spot minus LIBOR less futures price. Okay. Unused basis. Okay. Future closeout price in both cases. Tick size. Okay. So this is not required outcome of hedge and effective rate, but these things will be required because for premium as well, we need the tick. So let's start with number of contracts first. This is futures working because I need the futures closeout price. So let's just start with the future steps because this thing is required future closeout price. So first step is the number of contracts. Now I have told you that before starting this question, it's better to write some stuff that will be helpful for you. Now, before starting this stuff, what you should do is that you must record three things which have been taught to you. The first thing is today's date, then deposit or borrowing date, and then repayment date. So as you look at the question information, it clearly states that it is now 1st September. Okay, so I wrote this is 1st September. Okay, this is 1st September. Okay. Then deposit date on 1st February, it is due to receive an amount of 54 million, which it plans to invest. So deposit date is 1st Feb. And what is the repayment date is needed till 1st August. So this will help you calculate it that today is 1st September. You are depositing on 1st Feb. So 1st October, 1st November, 1st January, 1st February, and depositing after 4 months, right? Today is 1st September. You are depositing on 1st Feb. So 1st October, 1st November, 1st December, 1st January, sorry, 5 months. Today's 1st September. So 1st October, 1st November, 1st December, 1st January, 1st February. You are depositing after 5 months. For how many months? Till 1st August. So 1st Feb till 1st August count. 1st Feb, 1st March, 1st April, 1st May, 1st June, 1st July, 1st August. You're investing for 6 months, right? Today's 1st Feb. You're investing till 1st August. So 1st March, 1st April, 1st May, 1st June, 1st July, 1st August. You're investing for 6 months. And today's 1st September. You are expecting to deposit on 1st Feb. So 1st October, 1st November, 1st December, 1st January, 1st February. So you're depositing after 5 months for 6 months. And if deposit date is 1st Feb, you need a future for Feb. Since Feb future won't be available, you will opt for the next one. That is March future. Okay. So let's start working for futures. And the first thing which we need is the contract size. So for that is borrowed deposit amount over contract size into time period over 3. So let's find what is the borrowed deposit amount from the question. 54 million. Over contract size, 1 million. So 54 million over 1 million. 54 million divided by 1 million into time period of borrowing, 6 divided by 3. So number of contracts will be 108 contracts. Okay. Second step is basis risk, spot minus LIBOR less futures price. Okay. So basis risk is spot minus LIBOR. Spot is 100. What is the LIBOR going on? 3.25. Spot minus LIBOR less futures price. What is the futures price? 96.54, because you were expecting to receive money on 1st Feb. You will take Feb future, which is not given. So take the March ones. So spot minus LIBOR less futures price, 96.54, right? This will be then the third step is unused basis. So you were planning to receive money on 1st Feb, invest on 1st Feb. So you needed a 1st Feb future, but you took 30th March. So there are 2 extra months, whole Feb and 30th March, 2 extra months. And total months from today, 1st September to 30th March, 1st October, 1st November, 1st December, 1st January, 1st February, 1st March, and 30th March. So unused basis will be basis risk into extra months 2. Instead of 1st Feb, you took a future of 30th March, 2 extra months. Total months from today, 1st September to 30th March, 2 over 7. So it's a 0.21 to 2 by 7. Okay. Then the next step is future closer price in both cases. So okay. So the first case is LIBOR decrease by 0.5, because I am doing the working of LIBOR decrease by 0.5%. Okay. So let's find future closer price in case of LIBOR decrease. And then when I will be doing the increase working, I will do that. Okay. So now it's spot minus LIBOR. So spot minus LIBOR, 100 minus LIBOR, 3.25, but it's decreased by 0.5, so it will become 2.75. Less unused basis, that's 0.06. Okay, so it's 100 minus 2.75. Why did I take 2.75? Because this is the case where LIBOR has decreased by 0.5. So it's 3.25 decreased by 0.5, 2.75, less unused basis, 97.19. Okay. And the final thing is the tick size. Okay. So for tick, It states that contract size into 1 over 10,000 into 3 by 12. So contract size 10, 100,000 to 1 by 10,000 into 3 by 12. So this will make it okay. No need to go forward because this is basically the outcome of hedge and effective interest rate. This is not required. But the thing is that for callers, I needed all this stuff that exercise price, future closeout price, which comes from future, then exercise yes, no, gain in basis points if yes, total gain, actual cost of borrowing or return deposit, premium, net cost. Okay. So how will I get the futures closeout price? For that, I move towards the futures that the number of contracts calculated 108 basis risk spot minus LIBOR was 3.25 minus futures price that was given 96.54 because up till March futures. Okay. Then unused basis that 1st Feb was the receiving date. And I took future of 30th March. So it's 2 extra months, total months from today to 30th March, 7 months. Future closeout price in decrease case at the moment. Okay. And increase price, I will do it. So decrease case is 100 minus spot minus LIBOR. After 0.5 decrease, it's 2.75 instead of 3.25 minus 0.06. Okay. Then after that, it's basically minus unused basis. So unused basis has been done. And take contract size into 1 over 10,000 into 3 by 12. Now let's apply the collars properly here because as per collars, opt for put option at low strike price and call option at high strike price simultaneously. So let's find exercise price, opt for put option low strike price, call option high strike price. Okay. So put option is low strike price. See, put option is low strike price. Put is low strike price, 96.25. So let's apply her put option is low strike price. That is just a second, please. So put option is basically the low strike price. That is 96.25. And call option is the high strike price. See, call option is the high strike price. That is 97. So this is the first step of caller. Opt for put option low strike price, call option high strike price. So put option is the low strike price. See, and call option is the high strike price, 97. Okay. Future closeout price from futures. Now in futures, you know the future closeout price is there. Now it's the decrease case, right? Just a decrease case. So in decrease case, here, in decrease case, the future closeout price is 97.19. Okay. In decrease case, it's 97.19. Okay. So it was exercise price, put option low strike price, call option high strike price. Future closeout price from futures came 97.19. This is just the decrease case. I have to do the increase case again. But if effort is done here, then it would be easy. Okay. Exercise yes, no. Now, how do you do exercise yes, no? Now, you know, put is sell now, buy later. Put is sell now, buy later. Sell now. Okay. 96.25. Buy later. Sell now, buy later. So, you know, sell now, low, buy high, no. And if no, no need to work forward. Okay. And in call, buy now, sell later. Call is buy now, sell later. So buy now, sell 97.19. This is yes. Getting this thing? Because you know that firstly, what we used to do is that the exercise price is put. So it's put low strike price, call high strike price. So put was low strike price in the question. See, and call was high strike price. Get it? Future closeout price from futures. I'm just doing the decrease case, 0.5%. Okay, so if interest rates decrease, the future closeout price is this. 97.19. Now, how do you decide exercise? Yes, no. So put is sell now, buy later. Sell here, buy at expensive rate. No. Call buy now, sell later. Buy 97, sell 97.19. Gain, yes. Gain in basis points if yes. You don't have to do anything here. No working here. Gain in basis points, it's 19. Total gain. Remember, how did you calculate total gain? Gain in basis points into number of contracts into tick. Okay. So gain in basis points into number of contracts into tick. Okay. So this is how you got total gain. 51,300. Okay. Actual return on deposit. Remember how we used to compute actual return on deposit? Everything is there. Just the previous thing was that everything was calculated from above. Now I have to calculate actual return on deposit, actual cost of borrowing, amount into interest rate into time period over 12, amount into interest rate into time period over 12. So amount, that is how much? 54 million into interest rate. If interest decreased by 0.5%, the interest rate would be 2.75. Instead of 3.25, it would be 2.75. If interest rate decreased by 0.5, it would be 2.75. And you can deposit at base rate minus 30 basis points. So you can only deposit at 2.45%. Okay. If interest rates decrease by 0.5, 3.25 becomes 2.75, right? Because you're doing a decrease case. It becomes 2.75 instead of 3.25 if it decreases by 0.5. So it's 2.75 and you can deposit at 30 basis points less. So 2.45% you will get. Sir, why didn't you consider it above? This has been a major mistake which I told you in the classes, and people commonly do these type of mistakes. Here, the 30 basis points impact doesn't come. Okay, here it's just decreased by 0.5 to 2.75. The 30 basis points is being mentioned that you can invest funds. So it will only come when you are investing. Here you are not investing, so it didn't come. Here you are investing 54 million, so it's 0.5 less, so 2.75, 30 basis points less 2.45 into time period. How many time period? 6 months over 12. Okay, so this will be like this. It's 54 million to 2.45% to 6 by 12. Okay. 661500. And premium payable, the premium is the differential, right? What is the formula of premium? Premium into spot into number of contracts into tick. Premium into number of contracts into spot into tick. Spot contracts tick. Okay. But premium is the differential here. So what is the differential here? The premium 0.492. Premium differential into spot to number of contracts to tick. So let's put the premium working here. 0.492 minus 0.356. 36720 is the premium. Net cost or return. Sorry, this is the premium. Net return. You know that this is return on deposit. Okay. And this is gain. So gain will increase our return. We will add it. But premium is a cost that has to be paid. So we will deduct it. So net will be D59 plus D58, and the premium will be deducted. So it's 661,500 plus 51,300 minus 36720. 676,080 will be the cost. And if you want, you can find the effective rate. Remember, what is the formula of effective rate? The formula of effective rate is basically this: net cost return over borrowed deposit amount into 12 over time period 6. So net cost is basically 676,080 divided by 54 million into 12 divided by 6. So if you want to show it in percentage, 2.50%. Okay. Let me check the examiner's answer just a second on my cell phone, whether everything is okay. 676,080. Oh, it's perfect, right? So I think this made a lot of hard work, a lot of effort, but the primary reason was that the question directly asked in the requirements collars that demonstrate how short-term investment would be hedged on the basis of information, what the result of the hedge would be if interest rate rose or fell by 0.5%. Now, everything would remain same in increase or decrease. Because I've done the decrease case, I just have to increase. And in increase, this thing will change. Otherwise, the decision and everything would be like this. So I will do that. But firstly, let's understand that if we wanted to do this collar thing in requirements, if interest increase or decrease by 0.5. So I first moved towards the collar format. Okay, and the format of collar was that opt for put and call simultaneously low and high. So I wrote the format, put and call low high. Okay, and then exercise price, future closeout price, exercise yes, no, gain in basis points, total gain, actual cost of borrowing, return deposit, premium, net cost. Okay, so I made the format. Now exercise price was easy to capture from the question, right? Because it was clearly that opt for put at low strike price and call at high strike price. I wrote this 96.25, 97. What is the future closeout price? This made me realize that this is a big requirement now. For future closeout price, you have to go to futures. Number of contracts, borrowed deposit amount over contract size into time period 6 over 3. Basis risk, spot minus LIBOR is 3.25 minus futures price in February payment. You took March futures, 96.54. Unused basis, you took February deposit and took March future 30th. So 2 extra months. Total months today, 1st September to 30th March, 7 months. Future closeout price, if decrease case, then I will do the increase case. Spot minus LIBOR. Now LIBOR has decreased by 0.5, so it becomes 2.75 less unused basis. Then tick. Okay. Once it's done, put it here 96.2 97. This is the decrease case because you have to do increase and decrease both. So it's decrease. So future closeout price is 97.19. Took the decision. Exercise price put. Sell now, buy later. Sell low, buy high. No need to work. Call buy now, sell later. Buy 97, sell later. Yes. Gain in basis points if yes. Total gain in basis points into number of contracts into tick 51,300. Return on deposit is the amount into 30 basis points more or less for investing into time period 6 over 12. Premium is the differential into spot into number of contracts into tick. Premium has to be paid. Had it been a cost, I would have added premium, but since it's return, premium has to be paid, deduct, and gain will be added. Okay, net return and the effective rate. Okay, you have done the decrease case, we'll copy, then I will do the increase case, and that would be it. Okay. Okay, now I will obviously follow the same format because the question states you have to work for interest rates increase as well as decrease. So it demonstrates how short-term investments would be hedged on the basis of information and what result of it would be if interest rates rose or fell by 0.5%. So I went here in this question and it was clearly given that 1st February, Northney is due to receive 54, which it plans to invest until funds are likely to be paid on 1st August. So it's invested for 6 months. Base rate is 3.25. Prediction suggests could rise or fall by 0.5. Northney currently invest funds at floating rate minus 30 basis points. Group treasury function decided to use caller options. Okay, then options data is given and then the data. So you have to explain how short-term investment we hedge on which of information, what result would be if interest rates rose or fell by 0.5. So since you had to discuss a caller, so again, you will make format of caller. Okay. Now, if interest rates increase by 0.5%, so obviously, if it's increased by 0.5%, let's leave all these details. Now, if interest rates increase by 0.5%, the caller is to be made that put and call and exercise price because you need to enter into both options simultaneously. Future closer price from futures, exercise yes, no, gain in basis points, total gain, actual return deposit, premium payable, net return. Okay. Now, obviously, the exercise price is given that in callers we need to opt for put at low exercise price, 96.25, and call at high exercise price, 97.25. So I did that. Future closeout price from futures. Now, to get the futures closeout price from futures, there's a 4 or 5 step strategy. Only then you get the future closeout price, and this is how you need to do futures as well. Number of contracts, borrowed deposit amount 54 million, over contract size 1 million into time period of borrowing over 3. It's 108. Basic spot minus LIBOR less futures price. Futures price is given 0.21. Unused basis 0.21 into extra months because you needed to deposit on 1st Feb. You needed a 1st Feb future, but you took for 30th March. So 2 extra months over total months from today till 30th March, 7 months, 0.06. Future closeout price in both cases. Now it's increased by 0.5. Okay. Now increase by 0.5 means now it's spot minus LIBOR less basis. Okay. So future closer price if spot minus LIBOR less unused basis. So now LIBOR is not 2.75. You see it was 3.25 and now it's increased by 0.5. In the previous one, it was decreased by 0.5. 3.25 was the base rate LIBOR and it was you're doing the case of decrease by 0.5. So you took 2.75. Now it's 3.25 and you took the case of increase by 0.5. So 3.75 minus unused basis. Okay. So this will be 100 minus 3.75. Are you getting from where the 3.75 is coming? Because this is the case of increase by 0.5. So spot rate was 3.75, the LIBOR rate in 3.25, sorry. If it's decreased by 0.5, you take 2.75. It's increased by 0.5, you take 3.75. Okay. Tick is there. Now exercise price is there. Future closeout price from futures is 96.19. Yes, no. So input sell now, buy later. See, sell at 96.25, buy at less. Sell 96.25, buy at less price. Okay. So sell at this high price and buy now. Sell now, sorry, and buy later. Sell at 96.25, buy at 96.19. Since buy is low, sell is high. Yes. It's sell now. Sell at 96.25, buy at 96.19. Buying price is less, selling price more. So sell 96.25, buy 96.19 less. Gain, yes. And call, buy now, sell later. Buy 97, sell 96.19. So loss. Buy 97, sell lower price. Loss, no. If it's no, no need to work. Okay. Then it's gain in basis points. If yes, 6, 96.25 minus 96.1, 96. Total gain. Gain is basis points to number of contracts into tick. Actual return on deposit, it's 54 million. Into interest rates are rising by 0.5. So it's 3.75 less 30 basis points. So it's 3.45% into 6 by 12. See, 5,400,000 into how it was 2.45 in the decrease case because 3.25 was the LIBOR, 0.5 decrease, 2.75, 30 basis points less, 2.45. Okay. Now it's increased by 0.5. So LIBOR is 3.25, sorry, 0.5 increase, 3.75 less 30 basis points. So it's 3.45. Premium payable difference 0.492 minus 0.356 to spot number of contracts tick. Okay, net return, it's a return case. Okay, premium will be deducted, gain added. Gain increases return, right? Effective rate, net cost divided by, so net cost or net return is 910 divided by the borrowed or deposit amount, 54 million, into 12 divided by time period of borrowing is 6. I think you are done with it, that you have got if interest rates increase or decrease, both the cases. Effective rate. Okay, so I think the requirement is over now. How short-term investment be hedged on the basis of information result of hedge if interest rates rose or fell by 0.5. So I did the collar thing, short-term investment hedging. This one, short-term investment hedging. And in case of increase, decrease, both is done. If you want, you can copy this. I can write this in the appendix as well. Result of hedge is 676080 and 919080. Okay, so now only 2 theoretical parts are left. We will move towards that, but first you need to copy this. Okay. Okay, so I think this is now clearly understood with the students that how this hedging systems is working. So, final requirements, last two. Explain why treasury function might have decided to use currency futures and interest rate collar as hedging methods in part 3 and 4. So it is asking why treasury function might have decided to use futures and collars. So why it has decided to use futures and collars, this is related to here that group treasury function decided to use collars to hedge, and here group treasury function decided to use futures. Okay, so why treasury function might have decided to use futures and collars? You can write advantages of futures and collars, and you can write disadvantages of other methods to gain these 4 marks. Okay, because why it has decided to use futures and collars, advantages of futures and collars, and the others are not used, so disadvantages of them. Okay, so theoretical requirements we will write here. The treasury function may have decided to use futures as they are for standardized amounts and they are tradable as well. One good point of futures that they are for standardized amounts and they are tradable. Options may have not been preferred due to high premiums involved. Okay, so I wrote the advantage of future, that why they did use future. So they did not use options, so I can write the disadvantage of option, that options are not preferred due to high premiums involved. Callers may have been preferred as they limit the premium. Had you used options, in options you have to pay the full premium. Okay, either call, either put full premium. Whereas in callers, you limit the premium, you take the differential, so the premium is less. Let me explain it to you here. That had you used put option technique, you would have used this premium, right? 0.356. Had you used call option, you used this premium, 0.492. But in caller, you take the differential premium, so it's always less. So options are callers are also preferred as they limit the premium and they allow company to take advantage of favorable interest rate movements while preventing downside loss in case of unfavorable rate movements. And both of these assume basis as 0. However, both are based on certain assumptions which need to be focused before making final decision on which technique to use. Okay, so requirement 5 has been answered. And in requirement 5, the regie function, why they may have decided to use futures and collars. You know that we are not using forward exchange contract here. We are not using money market hedging. We are not using leading. We are only using futures and collars. So why they have decided to use futures and collars? Like if someone asks you why company using NPV. So advantages of NPV and disadvantages of other techniques. So why they are using futures and collars, advantages of them and disadvantages of other. Like they are not preferring options due to higher premiums involved. They are preferring futures due to standardized amounts, tradability feature. Collars, they limit the premium and they allow favorable movements and prevent the downside. Okay. But why did I add the last line? Although I was done with telling advantages of collars and futures and then drawbacks of options, why did I add this line? Just for professional marks. You always have to question something for professional marks. Okay. So I did the requirement that why they did use futures and collars, wrote the advantages of future collar, disadvantages of premiums. But just for a questioning mind, both methods are based on assumptions, like future is based on assumption C. Basis can be assumed to diminish to zero. And basis is assumed to diminish to zero. So both are assuming basis is zero. Both are assuming there is no basis risk and margin requirements. Here also, no basis risk, no margin requirements. So both are based on certain assumptions which need to be considered before taking final decision. This is just a questioning mind thing so that I gain the marks. Okay. So you can copy this, then I will move towards the last part. Okay, now last assess the political and operational risks which may affect the new subsidiary currently under consideration. So 10 marks, very easy and good marks because these are mark scoring in my opinion. Political and operational risks which may affect the new subsidiary under consideration. Okay, so this is the tab for new subsidiary. Northney is considering setting up its first subsidiary with sales and production facilities outside the US and Europe. At the moment, it only has operations in US and Europe. So Northney is considering setting up its first subsidiary with sales and production facilities outside Europe. Right? The group finance director suggested a country in which subsidiary could be based. This country has low tax rates, which are sustained by increasing level of government borrowing. It also has a limited employment and workforce regulation. It does, however, have regulations relating to workforce or subsidiaries of foreign parent companies. At least 75% employees of these companies must be home country citizens. So it is considering its first subsidiary outside US Europe. Group finance director suggested a country. They have not named the country, they have suggested a country in which we can establish subsidiary. Country has low tax rates, increased level of government borrowing. It also has limited employment and workforce regulation. It does, however, have regulations relating to workforce of subsidiaries of foreign parent companies. At least 75% of employees of these companies must be home country citizens. So you need to keep 75% employees as locals. The country recently decided not to join a regional free trade area which neighboring countries have established. It is currently in dispute with the regional free trade area over regulations applied to imports into the trading area from external countries. So, country has recently decided not to join a regional free trade area with neighboring countries. Neighboring countries have established a free trade area. The country has decided not to join. It is currently in dispute with the free trade area over regulations. One reason for establishing a subsidiary in this country is the demand in the region for robust commercial vehicles of the type which Northern manufactures. These are needed to cope with increasingly changeable weather, including more frequent floods. Why you are establishing subsidiary in this country? Because of demand of vehicles which we make, and these vehicles are needed for changeable weather like more floods. Okay, so this is the information of the new subsidiary, that I'm establishing my new subsidiary outside US and Europe. One country has been suggested by group finance director. It has low rates, it has regulations that 75% local employees must be citizens, and it is in dispute with the regional free trade area, and it has floods, and that's why our demand is high in this region. That's why we are going there. Okay. So political and operational risks which may affect the new subsidiary. Okay. So political risks. Okay. So political risks are usually the government laws related risk. Okay. So 75% employees. I'm just writing the points first, then I'll explain. 75% employees must be locals. So there is a risk that if they increase that, keep 80%, keep 90% employees are local, this can be a problem. Okay. Political risk, more regulation that give percentage holding to locals. It happens in some countries, right? Political risks, more regulation regarding transfer of funds. At the moment, they have low tax rates, but more regulation regarding high taxes, dispute with regional free trade area can lead to more taxes because you're in dispute with the free trade area. They may increase taxes on you. It's also a political risk. Okay. Let's move to operational risks later, but we have some political risks here that they have a regulation. Political risks are all the risks of regulation, the government risk that they are protecting locals. They might increase that, okay, give shares to locals. They may put restriction on remittance of funds because you are facing subsidiary here, head offices in US or Europe. You have to shift money there. High taxes can come, and regional free trade area, you're in dispute with them. They may put sanctions on you, and it might be difficult to work with sanctions. So you can elaborate them. I'm also doing that. Let's just elaborate it. There is a regulation in the country that 75% employees must be locals. There is a risk if government increases this percentage, then company may have to suffer. Okay. There may be more regulation in future that local citizens must have some percentage shareholding in foreign subsidiaries, which can complicate decision making. The government may introduce more regulation regarding transfer of funds earned in the country to foreign parent companies. In future, more regulation regarding high taxes can come. The country is currently in dispute with regional free trade area. The regional free trade area and other neighboring countries can put import, export restrictions with this country, and this can also lead to more taxes from imports from this country. Hence, Northney's sale to neighboring countries and regions may be affected. Okay, so I have written approximately 5 political risks here. What are political risks? Any government related risks, and that is usually regulation, high taxes, more regulation regarding transfer of funds, more regulation regarding local ownership, more regulation regarding keep more local employees. Okay, you are in dispute with regional free trade area, they may put more sanctions, more import export restrictions, more taxes on you. So Northney as a subsidiary in that country may not be able to sell to nearby countries just because it is in the country which has a dispute. So these are the political risks. Okay, it's us operational risks as well. Okay, so one operational risk, it's clearly visible here. that there are changing weather conditions, more frequent floods, so operations can disturb due to supply chain disturbances. Since there is increasingly changing, changeable weather. And frequent floods occur. There is an operational risk that operations and supply chain may get disturbed. Okay. What are the operational risks related to operations? Now, political risk is the government, legal, regulation risk. Operational risk, which can disturb your operations. Okay. So weather is an issue, floods is an issue, which can disturb your operations, supply chains can be disturbed. There may be difficulty in finding local experienced staff members who can perform work in the same manner and efficiency as existing staff, which can also lead to operational problems. The culture and working practices of people can be very different from Northney's home country, which can also create operational hurdles. Okay, so I personally think that you have written many points here, that political and operational risks. So operational risks are with respect to operations, like floods may disturb supply chain. Recruitment of staff may create an operational issue. Culture and working practice may be different. This can disturb operational hurdles, as what you are doing there, you won't be able to do here. Political risk, any legal or law related risks like increased taxation, hiring of employees, they may say that give them equity as well, keep more as locals. High taxes and transfer of funds, remittance, they can be a problem, political risk, and disputes with neighboring countries. So, all in all, these were the risks. Okay. So, we have completed this whole question, and where we did netting, where we did futures, where we did options, sorry, collars, the calculation, and these things are theoretical. Okay. So, this has ended the question number one. You can copy this, and that would be it for this question. We will then move towards question number two. Okay, so now let's move towards the question number two of this September-December 24 exam. This question is Mortex company, and it's the same pattern that following exhibits available on the left-hand side provide information relevant to the question, Mortexa, acquisition, takeover. Information should be used to answer requirements within your choose a response options. Let's read the requirement, okay? So exhibit number one is saying, Mortexa company operates a nationwide chain of supermarkets in Lannis, a country in Southern Europe. Lannis supermarket sector is highly competitive despite an increase in merger and acquisition activity over the last decade as rivals seek to maximize economies of scale. In response to a decline in Mortexa's profitability, directors are proposing their own acquisition and have identified a regional supermarket chain, Yecon, as a suitable target. Yecon is unlisted. Okay, now what is happening here? It says that Mortexa operates a nationwide chain of supermarkets. Okay, it is operating a chain of supermarkets uh, in Lannis. So Mortexa operates a nationwide chain of supermarkets. It's a supermarket chain in Lannis. Lannis is a country in Southern Europe. Lannis supermarket sector is highly competitive. Lannis supermarket sector is highly competitive despite increase in merger and acquisition activity over the last decade. Rivals seek to maximize economies of scale. In response to a decline in Mortexa's profitability, directors are proposing their own acquisition. Since Mortexa's profitability is declining, directors are proposing their own acquisition, have identified a regional supermarket chain, Yecon, as a suitable target. Yecon is unlisted. Okay. Second exhibit is acquisition of Yecon. Early discussion between companies boards indicate that Yecon's shareholders are expecting a minimum premium of 20% relative to their current market value. Yecon company's majority shareholder targets EPS, and it's unlikely it would approve any acquisition which causes a decline in EPS. Mortexa's finance director is proposing a share-for-share offer to convince Yecon shareholders to effectively invest in the future of the combined company. The proposal is to exchange 3 Yecon shares for 2 Mortexa shares. However, there has been a rumor that the rival is also interested in acquiring Yecon. Following information is available. For Mortexa, it is buying buyer, Yecon is the seller, PAT is given. Ordinary share capital is given, that means 800 million, and for $50 million on par value, 800 and 450 million shares. Mortexa's current share price is currently 8.22. Since both companies operate in the same industries, Mortexa's CEO has asked you to assume the same PE ratio can be used to value Yecon's equity. Okay. The acquisition will create annual post-tax synergies of 27 million based on expectation that the combined company will be able to negotiate lower prices with its suppliers while also eliminating functional areas which are duplicated. Mortexa believes the company's post-acquisition P ratio will increase by 10% if the acquisition is approved. Okay. Then the takeover investigation. The Competition Authority in Lannis is a government department responsible for promoting competition and restricting anti-competitive practices. As a general rule, department investigates any takeover acquisition which creates a combined company with a market share of at least 25%. Mortexa's post-acquisition market share is predicted to exceed this threshold, but at 26% only very slightly. Okay. I will read these paragraphs in detail, but the Competition Authority in Lannis is a government department responsible for promoting in competition, restricting anti-competitive practices. As a general rule, department investigates any takeover acquisition which creates a combined company with a market share of at least 25%. So government department, Competition Authority investigates any takeover which creates a market share of 25%. Mortexa's post-acquisition market share is predicted to exceed this threshold, but at 26% only very slightly. Competition policy in Lannis recognizes there is a potential for merger and acquisition activity to harm competition and reduce consumer welfare, for example, through higher prices, reduced quality of choice, or lower levels of innovation. However, there is also an understanding that merger and acquisition activity can benefit consumers by promoting efficiency gains, which may result in lower prices or through investment. Now, competition policy is recognizing that mergers and acquisition harms competition and reduces consumer welfare. Why? Two companies are fighting. Consumers benefit. Both of them combined, they charge a joint price, higher price, so consumers suffer. So competition policy says it can harm competition. But there is an also understanding that merger and equity can benefit consumers by promoting efficiency gains. But if it's used positively, if two companies combine, efficiency creates, which may result in lower prices. For example, there is an expectation that Mortexa will achieve significant cost synergies if the acquisition is approved. In addition, Mortexa CEO believes combined company will be able to invest in new mobile phone application to help respond to competition from online supermarkets. This will create new jobs. Any competition authority investigation will therefore balance the benefits of a takeover against any potential harm to competition. So that's it for the three exhibits. Let's just recap what is there in the exhibits. Exhibit number one, very easy. Mortexa operates a nationwide chain of supermarkets in Lannis. So Mortexa is operating a chain of supermarkets in Lannis. Lannis is a country in Southern Europe. Lannis supermarket sector is highly competitive despite increase in merger and acquisition activity as rivals seek to maximize economies of scale. In response to a decline in Mortexa's profitability, directors are proposing their own acquisition. Directors want acquisition. They have identified supermarket chain Yecon as a suitable target. Yecon is unlisted. Okay. Second paragraph. Early discussion between both companies' boards indicate Yecon shareholders are expecting a minimum acquisition premium of 20%. Shareholders want a premium. Yecon, you are buying Yecon, their shareholders expect a premium of 20% relative to the current market value. Yecon company's majority shareholder targets EPS. It is unlikely it would approve any acquisition which causes a decline in EPS. Now, please understand its point. Yecon shareholders want a minimum acquisition premium of 20% relative to current market value, but majority shareholder is targeting EPS. He is unlikely it would approve any acquisition which causes a decline in EPS. Mortexa's finance director is proposing a share for share offer. Finance director proposes a share for share offer. To convince Yecon shareholders to effectively invest in the future of the combined company, the proposal is to exchange 3 Yecon shares for 2 Mortexa shares. However, there has been a rumor that another rival is also interested in acquiring Yecon. PAT of Yecon and number of shares are given. Okay. Mortexa's share price is 8.22. Both companies operate in same industries. Mortexa's CEO has asked you to assume the same PE ratio can be used to value equity. So here I can do one thing. That Mortexa current share price $8.22. Okay. Both companies operate in same industry. Mortexa's CEO has asked you to assume that same P ratio can be used to value equity. CEO is saying that use same P ratio to value Yecon's equity. So same PE ratio to value Yecon. So I need to find the PE ratio of Mortexa because the CEO is saying to use the same PE ratio to value Yecon. So I must need the PE ratio of Mortexa. It's market price per share over earnings per share. So I first need EPS of Mortexa, right? How will I get the EPS of Mortexa? What is the PAT? Less preference dividend 0, number of shares 800 million. Okay. So 548 over 800. So it's 548 divided by 800. This is the EPS. So market price per share over EPS gives you the PE ratio of Mortexa. And the CEO is saying to use the same PE ratio for valuing. CEO is saying to use the same PE ratio to value Yecon. Okay, so this was not a requirement at the moment, but since it said that use the same PE ratio, Mortexa's share price 8.22. Both companies are in the same industry. CEO has asked you to use the same P ratio that can be used to value Yecon. So I just calculated the P ratio of Mortexa because I need to use the same one, market price per share over EPS. Okay. And then it says acquisition will create post-tax synergies of 27 million based on expectation that combined company will be able to negotiate lower prices with its suppliers and eliminate functional areas which are duplicated. So acquisition is creating synergies because suppliers will lower the prices because two companies have combined, they have the power and duplications will be removed. And CEO believes post-acquisition P ratio will increase by 10%. So after acquisition, the P ratio will increase by 10%. At the moment you have found it 12, use the same P ratio to value Yecon, but after acquisition, it will increase by 10%. Okay. And then there is a third thing that there is competition authority investigates if market share breaches 25%. Here, the combined company will make a market share. Both will combine into one company will become 26%. Competition policies say that combination of the companies harm consumers, but they also provide benefit. So CEO is saying that combined company will also invest in new application to create jobs, and competition authority investigation will also see the benefits as well as harm to consumers. Okay, so that's it for the question. Let's move towards the requirements. What are the requirements? Okay, so the requirement number A is calculate the pre-acquisition value. So important thing is pre-acquisition value of equity for both Mortexa and Yacon, and estimate additional value that will be created by the proposed acquisition. So in my opinion, it's a very easy question. I first need to find pre-acquisition value of equity for Mortexa, for Yacon, and additional value that will be created by this proposed acquisition. So first requirement is pre-acquisition value of Mortexa. Pre-acquisition value of equity. Right? Then you have to find pre-acquisition value of equity of Yacon. And finally, the last thing which you need is additional value that will be created by acquisition. So we all know, we have studied it multiple times, that for additional value created, okay, we must generate for additional value created the combined company value less individual values, value of Mortexa, value of Yacon. So if you take the combined company value and deduct Mortexa and Yacon, additional equity value. Okay, let's start. Pre-acquisition value of equity of Mortexa. Okay, so how can you find the value of Mortexa? I don't think so. It is very difficult because to find pre-acquisition value, there is NAV, net asset valuation model, DVM model, P ratio model, and stuff like that. So NAV method cannot be applied in net asset valuation. You don't have assets at DVM. There's no dividends. There is only PE ratio mentioned. So you can find the equity value pre-acquisition of Mortexa through PE ratio method. And for PE ratio method, it's PE ratio into EPS. Okay, value or share price. Value or share price is the same thing. It's just the difference that if it's per share, value per share, we calculate its share price, or if it's total, we call it total value. So what is the P ratio of Mortexa? It's 12 times, just found above 12 times. And what is the EPS? PAT less preference divided over number of ordinary shares, 0.685. So pre-acquisition value of Mortexa will be B8 into B9. Now, since you put earnings per share, I got the value per share. And for total value, I just need to multiply it with number of ordinary shares. So it's 8.22, that is B11, sorry, B10. To number of shares are 800. 6576 is the pre-acquisition value of Mortexa. Now, had I not put here earnings per share, had I put the total earnings, PAT 548, I would have directly got the total value. But since I put earnings per share, I got the value per share into number of shares, total value. Okay. Now, if I need to move towards the pre-acquisition value of Yacon, how will you find the pre-acquisition value of Yacon? Again, there is no dividends, no assets given, so NAV DVM cannot be applied. You can only use the PE ratio method. CEO has asked you to assume the same P ratio can be used to value Yacon. Same P ratio for Yacon. So value will be found through P ratio. That is PE ratio into EPS. So 12 and EPS. EPS for Yacon is PAT 135 less 0 over 450. Okay. So P ratio into EPS will give you value per share, also called as share price for Yacon. It's B14 into B15. And if you want to find total value, you simply need to multiply it with the number of shares. So what are the number of shares? Number of shares are B16 value per share into 450 million shares, total value. So you've got the pre-acquisition value of equity of Mortexa and Yacon. Had we put NAV cannot be applied and that DVM cannot be applied. P ratio mention was given, so P ratio into EPS, I got value per share or total value into number of shares. Okay. Then additional value created. So you know that additional value created is combined value less value of Mortexa, value of Yacon. Okay. I will first find the combined value here. Now, how do you find the combined value? Again, there are FCF methods, there is NAV method, there is DVM, there is P ratio. What can be applied here? Mortexa CO believes company's post-acquisition P ratio will increase by 10% if acquisition is approved. So again, the P ratio will increase by 10% if acquisition is approved. So you have only choice to find the post-acquisition value through P method because no other information is given, right? So you will find it through P ratio method. That is P ratio into EPS. P ratio into EPS. So P ratio of the combined company will be 12 to 1.1. And if you put EPS, you get value per share, or instead of EPS, total PAT. You directly get the total value. Same could have been applied here. I multiplied with EPS. Okay. Had I not multiplied with EPS 0.3, had I just put the total PAT 135, I would have directly got 1620. See, total value. Okay. But since I found the EPS, so I got value per share and then total value. Okay. So for combined company value, it's again the P ratio method, P ratio into EPS, or total earnings, total PAT, same thing. What is the total PAT? Now, total PAT will be PAT of Mortexa. That is 548 plus PAT of Yacon. That is 135 plus acquisition will 3x post-tax synergy of 27 million. So acquisition will also give you another PAT, 27. $710. Okay. So you have got the total PAT. So P ratio into EPS gives value per share, P ratio into total PAT gives you total value. G15 into G16. This is the total value of the combined company. So combined company value is 9372 less individual value is 6576 for Mortexa, and it's 1620 for Yacon. You will get the additional equity value $1176. Okay, so I think our 5-mark requirement is over. You needed pre-acquisition values of Mortexa and Yacon, so it's just P ratio in TPS, so total PAT. Then additional value, combined value less individual values, you get additional value. Okay, you can please copy this so that I can move towards the next part. Okay, now the next requirement here. I think this was a very easy requirement, pre-acquisition value of equity for both Mortex and Yacon. I got the pre-acquisition value of equity for Mortex and Yacon, P ratio into EPS, very simple. Additional value, combined value, again, P ratio into EPS, and individual values, okay? Second, 5 marks again, estimate the impact of the acquisition on wealth of both company shareholder, including impact on EPS for Yacon's majority shareholder. So estimate the impact of acquisition on wealth of both company shareholders. So you need to find the estimate the impact of acquisition on wealth of both company shareholders. Wealth means share price. So impact on both company shareholders, buyer, seller, and impact on EPS for Yacon's majority shareholder. So, okay. Second requirement, impact and wealth of both companies' shareholders. So first is Mortexa shareholders. Okay. Now, how do you find impact on wealth of both company shareholders? Wealth is determined by share price. So to see impact on wealth of both company shareholders, you need to find current share price and then post-acquisition, also called combined company share price. This will help you give the percentage gain or percentage increase, decrease in wealth. In the same requirement as percentage gain. Okay, if it said percentage gain, both shareholders would get. So percentage gain is got by current share price and combined company share price. Instead of percentage gain, it's asking impact on wealth of both company shareholders. So we all know wealth is determined by share price. So when you are asked to find impact on wealth, wealth means share price, impact on share price, current share price, combined company share price. Okay, what is the current share price of both? Okay, so current share price of Mortexa was 8.22. Okay, combined company share price. Okay, it's very easy. Combined company share price. What is the combined company value? 9372. Okay, combined number of shares. You will get combined company share price. Okay, so what are the combined number of shares here? What are the combined number of shares here? Pay attention. We have done this thing in the classes. Combined number of shares. Okay, what are the number of shares here? 800 million over to 1, 800 and 450. So usually at first sight, the combined number of shares are 800 million plus 450 million. Okay. These are the combined number of shares, 800 plus 450. But that is the case when 1:1. Okay. Now what will happen? When both companies combine, this has been discussed in the class, right? This company's shares will become Mortexa shares. Their shares will be cancelled. Now, whoever is the Mortexa shareholders, they will also be owning Acorn, okay? Because you are paying them, their shares will be cancelled. But what you're doing, you're not paying cash. Had you been paying cash, then 450 million shares cancelled, you paid cash. Only the combined company has 800 million shares because this 450 million shares you purchased, that's cancelled. You paid cash. The combined company has 800 million shares. But what you are doing, you are giving them share for share. And what is happening? 3 Acorn shares for 2 Mortex shares. That means you are issuing more shares, 2 shares against 3 shares. So what will happen? The combined company number of shares will be 800 million plus 450 million. And against their 3 shares, you are giving them 2 more shares. So into 2/3. Remember, this thing has been studied in the class. So 800 million shares plus 450 million shares, the combined shares will be 1250 if it's 1-for-1. But since out of their 3, we are paying 2, so their shares will go by 3 and increase by 2. Okay, so the combined number of shares will be 1100 and combined share price will be G17 divided by G18. I hope you remember this from the classes that the combined number of shares are 800 plus 450 cancel if it's a cash offer. If it's 1-for-1 offer, 800 gone, 450 came, and we issued 1 more share against 1 share. So 450 cancelled and 450 new. So 800 plus 450, 1250. But here, against their 3, we're giving 2, so divide by 3 by 2, 1100 shares combined share price. Okay, so current share price of Mortexa was 8.22 and combined company share price was 8.52. So how much percentage increase did Mortexa shareholders got? It's the gain of 0.3 divided by base is 8.22 into 100. 3.64%. 3.64%. Okay. Yacon company. Current share price of Yacon company. What's the current share price of Yacon company? It's 3.6. and combined share price 8.52. If you do like this and find the percentage gain, you know you will make an error, because what did I teach you? Current share price is 3.6. For percentage gain of Yacon shareholders, not 3.6 and 8.52. Current share price is 3.6. They are giving their 3 shares. They are giving their 3 shares. So they're investing 10.8, and they are getting in return 2 shares of the combined company, 8.52 into 2. 17.04. So the percentage gain is 17.04 minus 10.8. It's 6.24 divided by the base. 57.78%. So this is the percentage gain for both group of shareholders. Okay, percentage gain or increase in wealth is the same thing. Wealth is determined by share price. So for increase in wealth, current share price, combined share price. For percentage gain, current share price, combined share price. Okay, current share price is 8.22, combined share price 8.52. I divide by the number of shares, 3.65% for Mortexa. For Yacon, current share price is 3.6, but they've given 3 shares, against get got 8.52, 2 shares. Okay, there is one more thing which is being asked in this question. Estimate the impact on EPS, earnings per share, for Yacon's majority shareholder. What is the impact on EPS? So impact on EPS is also calculated in the same manner. Impact on EPS is also calculated in the same manner, right? And it's asking impact on EPS for Yacon's shareholders. How do you define impact on wealth? Wealth by share price. So impact on EPS. Current EPS of Yacon. And combined EPS. So what is the current EPS of Yacon? We have just calculated current EPS of Yacon as 0.3, right? Combined company EPS. What is the combined company PAT? Remember, combined company PAT 710 divided by combined company number of shares, 1100. Okay. So combined company PAT needs to be divided by the EPS to get, number of shares to get the combined EPS. So combined company EPS, combined PAT is 710 as calculated above, minus preference dividend divided by combined number of shares, 1100. Okay. So 0.65. Okay. So percentage increase in EPS 0.35 divided by 0.3. It's approximately 116%. So I think a shareholder will be very happy with such an increase in EPS. Okay. So I have done requirement 2. I have the impact on wealth of both company shareholders, current and combined share price, impact on EPS, current EPS, and the combined EPS. Okay. You can please copy this, then I will move towards the A3. Okay, so after doing this requirement, that uh, requirement number 1 and 2, that pre-acquisition value, 5 marks, impact on acquisition on the wealth of both company shareholders, including impact on EPS, we have done that. A3, advise Mortexa's board whether or not the acquisition is likely to be approved by both company shareholders. So you need to advise whether acquisition will be approved by both company shareholders. Okay. So whether acquisition will be approved by both company shareholders. So for A3, I will write it on Word. Whether acquisition is likely to be approved by both group of shareholders. So if we talk about both shareholders, the buyer's shareholders are getting 3.65% increase in wealth, and the seller shareholders are getting 57.78% increase in wealth. Okay. So at first sight, you will write Mortexa's shareholders are getting benefit of 3.65%, whereas Yecon shareholders are getting benefit of 57.7%. So ideally, it may be acceptable for both group of shareholders. However, Mortexa's shareholders may argue that their percentage increase is very low compared to Yecon shareholders. Okay. There was one thing mentioned in the question that Yecon shareholders expect premium of 20% related to their current market value. Okay. Yecon shareholders were expecting a 50% premium above market value, and they are getting almost 57.7% or 58%. So it will be very much attractive for them. Similarly, there's one more thing mentioned. Majority shareholder targets EPS. It is unlikely would approve any acquisition which causes decline in EPS. So EPS is also increasing. EPS is also increasing, which means Yecon's majority shareholder will also accept it. There is a possibility, because professional skills, commercial acumen, questioning mind, skepticism, that Mortexa shareholders may want to negotiate premium, as it's very much higher than expectation. They want premium of 20%, and the premium they're getting is 57.78%. So the buyer shareholders may negotiate them, but overall, the deal may be approved by both group of shareholders. Okay. So you can copy this. I think for 3 marks, there were 3 points required. I've written many. Okay, now let's move towards the next part of the question. Part B, 7 marks. Explain factors Lannis Competition Authority is likely to consider if it investigates Mortexa's acquisition of Yacon. So you all know this is not a requirement from the book. People say read the book and theory will be improved. Okay, somewhat maybe fine. But there are usually scenario-based requirements to explain the factors Lannis Competition Authority is likely to consider if it investigates Mortexa's acquisition. Now, this is related to takeover investigation. Competition Authority in Lannis is a government department responsible for promoting competition, restricting anti-competitive practices. As a general rule, department investigates any takeover acquisition which creates a combined company with a market share of at least 25%. Mortexa's post-acquisition market share is predicted to exceed this threshold, but at 26%, only very slightly. Competition policy recognizes the potential for merger and acquisition activity to harm competition and reduce consumer welfare, for example, through higher prices, reduced quality, or lower levels of innovation. However, there is also an understanding that mergers and acquisition activity can benefit consumers by promoting efficiency gains, which may result in lower prices. For example, there is an expectation that Mortexa will achieve significant cost synergies if the acquisition is approved. In addition, Mortexa CEOs believes combined company will be able to invest in new mobile phone application to help respond to competition from online supermarkets. This will create new jobs. Competition authority investigation will therefore balance the benefits of takeover against potential harm to competition. This is the takeover investigation paragraph. And it is saying explain factors Lands Competition Authority is likely to consider if it investigates takeover. Now, trust me, all the factors that competition authority is likely to consider if it investigates the acquisition are given in the scenario. You just need to highlight it. So Competition Authority in Lannis is a government department. It is responsible for promoting competition, restricting anti-competitive practices. General rule, department investigates any takeover acquisition which creates a combined company with a market share of at least 25%. Mortexa's post-acquisition market share is predicted to exceed this threshold by 26%, very slightly. So what factor competition authority is likely to consider? The first factor is given. The first factor which competition authority may consider is this market share. The competition authority will consider the market share. Their threshold is 25%. In this acquisition will create combined company share of 26%, which may be a sign that they might hold the market and launch anti-consumer policies. Okay. So what factors competition authorities likely to investigate? The first one is written that competition commission investigates any takeover which exceeds 25%, because when market share is above 25%, that means you have a major market share. You can do monopoly, you can exploit customers. So they want companies to have a less market share. Since this acquisition is likely to make it the market share 26%, only slightly as well by 1%, but still they will investigate market share that if this acquisition goes ahead and the market share becomes 26%, they may start ruling the market, monopoly, stuff like that. Okay. Competition policy in lands recognizes there is a potential for merger and acquisition activity to harm competition and reduce consumer welfare through higher prices, reduced quality, or lower levels of innovation. Another factor which they may investigate is that when this takeover goes and the market share goes high, two companies combine, the options for the public get reduced. Combined companies have a more power. They might increase prices, reduce quality. They might consider this factor as well. And they might consider this factor as well, that this activity can benefit consumers by promoting efficiency gains, which may result in lower prices or job creation. For example, when two companies combined, synergies are created, duplication is avoided, so costs fall. If that impact is passed to the consumer, the prices may fall. So these factors can also be considered by the competition authority. Combined companies may have more power and they may start charging higher prices and may offer reduced quality, which can create problems for consumers. Okay. They may also consider efficiency gains, that if merger takes place and two companies get combined due to synergies, the cost may fall. And if that impact is passed on to consumer, it may result in lower prices. So you see, all these points are mentioned in the scenario, and I'm taking from there. And they will also consider that combined company will invest in new mobile phone application, which will create jobs. Application, which may help job creation. These are the points which basically are mentioned in the scenario. Now, if you want to write some further points, you can write them as well. Like what you can say here is that if like this, like if duplicate functions are reduced, like both companies are getting combined and the duplicate functions are being reduced, this may result in loss of jobs. Okay, so this is also a factor that needs to be considered, that they are combining functions, and this may result in loss of jobs. If both companies combine and increase market power, after a few years, they may acquire some small companies effectively moving towards a monopoly setup. So any investigation will focus on benefits of merger compared with costs of merger for public before getting approved. Okay, so that's it for this question. Please copy this so that we can move forward. Okay, let's move to the new question now. This is the next question of September-December 2024. That's Zulla Company. Again, there are 3 exhibits. So let's see what these 3 exhibits are. Zulla Company initial public offering. The first exhibit, Zulla Company is an unlisted company originally founded by a group of friends who are the company's executive officers. It is involved in successful production of online games and experiences and has built an excellent reputation in this area. The Zulla Company has recently developed an innovative online gaming platform. Zulla's executive officers are of the opinion that they will need extra funding in order to commercialize the gaming platform successfully and are therefore looking to list Zulla through an IPO. So the thing is that Zulla is an unlisted company. It is founded by a group of friends who are company's executive officers. It is involved in the successful production of online games and experiences. Has built an excellent reputation in this area. Zulla has recently developed an innovative online gaming platform. Executive officers are of the opinion that they will need extra funding in order to commercialize the gaming platform successfully and are therefore looking to list Zulla through an IPO. They are manufacturing games. They have good reputation. They have developed innovative annual gaming platform, and executives want funding, so they are looking to list via an IPO. Because when IPO, you will issue shares, you will get the funding. Second exhibit. The company's CEO is of the opinion that the company current equity value can be estimated based on Zulla's expected future dividends. So CEO is of the opinion that company's current equity value can be estimated based on Zulla's future dividends. Chief Financial Officer is not convinced by CEO's opinion and thinks that Zulla's current equity value should be estimated based on FCF to the firm. That means FCF to the company. Okay. So CEO is of the opinion that current equity value can be estimated based on future dividends. CFO is not convinced by CEO's opinion of dividends and is saying equity value should be determined by FCF to firm. The following financial information can be used to estimate Zulla's current value before it undertakes the IPO. Zulla has not been able to pay a significant level of dividend as it has constantly needed cash to fund its online games and experiences development. Company is expected to pay dividend of only 0.06 per share in each of the next 3 years. 0.06, 0.06, 0.06. In year 4, dividends are expected to increase to 0.2 per share and then grow by 10% per year every year thereafter. Okay. The most recent financial information shows that Zulla's revenue was 603. After-tax profit was 32. In estimating the after-tax profit, TAD of 12 million, interest of debt of 4 million, and tax of 8 million have been deducted. It is estimated Zulla made an actual cash investment of 20 million in non-current assets and working capital. It is estimated that over the last 5 years, Zulla's growth rate of revenue, profits, and cash flows have been largely the same. 5 years ago, the revenue was 358 million. So it is estimated that over the last 5 years, growth rate of revenue, profits, cash flows has been the same. 5 years ago, revenue was 358. Today's revenue is 603. And today's revenue is 603. 5 years is 358. And over the last 5 years, growth rate has been the same. So you can find the growth rate from this data. Today's sales 603, 5 years ago 358. You can get the growth rate. Zulla aims to maintain long-term gearing of 10% debt to 90% equity in market value terms, has 110 million shares in issue. Company's current cost of capital is 14%. Its cost of equity is 15%. Zulla pays tax at 20%. So FCF to the firm, that means you will be needing WACC, not K. So cost of capital is 14%. After the IPO has taken place and the new gaming platform has been commercialized, Zulla's company's executive officers think there will be subsequent 30% increase in company's equity value. So after the IPO, they are thinking that there will be a 30% increase in company's equity value. Okay. So in this, dividends are given for the next few years, and the free cash flow data, the PAT, the TAD, the interests, and tax is given. Then there is a third exhibit, reverse takeover option. Zulla's CEO has heard that IPOs can place a significant burden on companies. He has also heard that a company can effectively obtain the same outcome, but with a significantly less burden by undertaking a reverse takeover. So Zulla's CEO has heard IPOs can place a significant burden on companies. He has also heard that company can effectively obtain the same outcome, but with significantly less burden by undertaking a reverse takeover. This will involve Zulla taking control of a non-trading listed company, and then the listed company will acquire Zulla, where Zulla will effectively obtain a listing. CEO is wondering if Zulla would benefit more from obtaining a listing through a reverse takeover instead of an IPO. So in IPO, you issue shares and get listed, whereas it's thinking of a reverse takeover. I have taught you this. In reverse takeover, Zulla will take control of a non-listed company, and then that non-trading listed company, because you are unlisted, Zulla is unlisted, it will acquire a non-trading listed company, and that listed company will acquire Zulla. This is a reverse takeover, and CEO wants whether it's more beneficial, RTO or IPO. So that's it. Now we move to the requirements. Okay. Based on the financial information provided, estimate Zulla's equity value based on dividends and on FCF. So you need to estimate Zulla's equity value based on dividends as well as on FCF to the firm, if it undertakes the IPO and commercializes its gaming platform successfully. Okay. So I need to find equity value based on dividend as well as on FCF. Okay. If it undertakes IPO. Okay. So this is my requirement. Zulla's So I have to do this under DVM, and then I will do it under FCF. So firstly, Zulla's equity value under DVM. That's the requirement, that Zulla's equity value based on dividends and on FCF. So first, it's based on dividends if it undertakes IPO. The company CEO is of the opinion that company's current equity value can be estimated based on future dividends. Company CFO is not convinced and thinks that equity value should be estimated based on FCF to firm. Okay. Following information can be used to estimate Zulla's current value before it undertakes IPO. Zulla has not been able to pay a significant level of dividends as it has consistently needed cash to fund its online gamings and experiences development. Company is expected to pay 0.06 per share in each of the next 3 years. Year 4 dividends will become 0.2 per share. And then after year, what do you say, 4, 10% every year. Okay. So you need to find equity value of Zulla based on dividends. Okay, equity value based on dividends. Now, under DVM, how do you find equity value? If past dividends are given, okay, if past dividends are given, how do you find equity value through DVM? P naught is equals to D1 upon K minus G. But if future dividends are given, which is the case there, 0.06% for the next 3 years, then 0.2. Future dividends are given, you know that value under DVM, equity value under DVM, is basically the present value of all future dividends discounted at K. So present value of all future dividend discounted at K. What future dividends are given? 1, 2, 3. 0.06. In each of the next 3 years. In year 4, 0.2. And 5 to infinity. %10 increase. So 0.2, 10% increase. Okay. 0.06 in 1, 2, 3. In year 4, 0.2, and then 10%. Dividends. So in DVM, the equity value is if past dividends are given, P naught equal to D1 upon K minus G. If future dividends are given, present value of all future dividend discounted at K. So future dividends are given, discounted at K, 15%. So let's find the factors for this. So 1 upon 1 plus R power N, or you can watch it from the tables. 0.870, 0.756. $658,572. And remember, to infinity. Take the last discount factor upon KE minus G. So KE is 15% minus G. So KE minus G is basically last discount factor 0.572 upon KE minus G. So see this working. Last discount factor 0.572 upon KE 0.15 minus G. Okay. So multiply to get present value. So let's just work around like this, that it's C4 into C5. And I will drag it. So total present value of all future dividends is basically value under DVM. So you'll take the sum of C6 to G6. Okay. 2.7684. This is the value of all future dividend. That's the value. It's per share. And how many number of shares they have? 110 million shares. So total value will be B8 steric B9 million. Now, one thing you need to pay attention, if you stop here, you will lose 1 mark. Why? Because you need to be alert in the exam. The following information can be used to estimate Zulla's current value before it undertakes the IPO. See, this is value before it undertakes the IPO. So following information can be used to estimate its value before it undertakes the IPO. So before it undertakes the IPO, the dividends are this, and growth. So since DVM was asked, so present value for all future dividend discounted at K, you get the value. But this information is for value before it undertakes the IPO, whereas the requirement is value under DVM if it undertakes the IPO. Okay, so what will happen? You can use this last paragraph. After the IPO has taken place and the new gaming platform has been commercialized, Zulla's executive officers think there will be a subsequent 30% increase in equity value. Okay, so this value is used for the before data. And total value after IPO will increase by 30%. So you just need to increase this B10 by 30%. That's it, 395.858. Okay. So I have done this requirement, Zulla's equity value, if it undertakes IPO under DVM. So for DVM, since past dividends were not given, P naught is equal to D1 upon K minus G cannot be applied. Future dividends were given, present value of all future dividend discounted at K. I got the value, but this was for before IPO. After IPO, 30% rise. That's it. Okay. Please copy this. Okay, now the next thing is that if the question is asking you Zulla's equity value under dividends and Zulla's equity value based on FCF, free cash flows to the firm. I am being asked to find Zulla's equity value based on dividends and on free cash flows. Okay, so now I have found the value under DVM. Now I'm finding under FCF to firm company. So if I want to find value under FCF to company, I first need to write down the format of FCF to company. You know, it's revenue less cash costs, then TAD. So you end up at operating profit or PBIT. Then basically it's interest, which FCF to company doesn't come. And you end up at PBT. Then you pay tax on it. Okay. Then you add back TAD. Okay. Then less investment in NCA. And then investment in working capital. So you get FCF2 company. Then you use a discount rate, which is WACC. You get value of company. Then you deduct value debt to get value of equity. Okay. This is the format for FCF2 company, right? And now I need to find value of Zulla through FCF2 company. In the first phase, I was asked a value under DVM, so present value of all future dividend discounted at K. Maybe I think it's a very easy requirement. But under FCF2 company, I first have to write the FCF2 company format. Okay. Now, once I've written the format, let's start with FCF. Okay. Okay. So now if you need value under FCF, so FCF to the firm as per the financial information. So I've written the format of FCF to the firm. It's basically revenue less cash costs and TAD. So you reach up at PBIT, then interest, so you get PBT, then tax, and then you get add back TAD, investment in NC, investment working capital, FCF to company, discount rate, which is WACC, value of company, less value of debt, value of equity. Okay, so let's start with revenue, cash cost, TAD, PBIT. Okay, so I think the best starting point is PBIT. So from this financial information, you can find PBIT. So the PAT is 32. PAT is 32. So you know to reach PBIT, you have after tax profit PAT. For PBIT, you can add back interest and tax. So interest is 4 million and tax is 8 million, right? So to start with PBIT, you have been given PBT, sorry, PAT. PAT is after interest and tax. So PBIT is you add back interest and add back tax. So PAT is 32, add back interest 4, add back tax 8, right? So PBIT will be 32 plus 4 plus 8, 44. 44 million. This is PBIT, right? How did I get PBIT? Because PBIT is the best starting point. I got PAT, profit after tax. I added back interest and tax to get PBIT. Interest. You know, interest doesn't come. Okay. So if 44 is the PBIT and interest doesn't come, your PBT will become 44. Okay. Then, because interest doesn't come, so PBT is 44. Then tax, 20% tax. So minus 0.2 into 44. 8 point is the tax. Add back TAD. How much is the TAD? 12 million. So 12 million is the TAD. Investment in NC and investment in working capital. So investment of 20 million in non-current assets working capital. So it's not separate, it's just one figure given. Investment in NC and working capital. So both combined figures are 20 million. Okay, you can ignore this because 20 million is NCA and working capital combined. So you will get FCF to company. Let's find FCF to company. It's 44 minus 8.8 plus 12 minus 20. FCF to company. Okay. Discount rate is WACC. Okay. So WACC is how much? 14%. You're not given many years. So what do we do? Last discount factor last year is 0, right? So the discount factor is last discount factor year 0, 1 upon WACC minus G. What is the growth rate? Now, the growth rate here is a problem. It says that over the last 5 years, growth rate has been the same. Okay. Over the last 5 years. 5 years ago, revenue was 358. Today's revenue is 603. So you can find the average growth rate of last 5 years as we used to do in the classes. That 5 years ago, revenue was 358 and now it's 603. The growth rate is same. So you can do 603 divided by 358. This is the 5-year growth rate. And power 1 divided by 4. Power 1 divided by 4. Okay. Minus 1. So growth rate comes 11%. Okay. Remember, this has been done in the classes question as well, that revenue is 603 million. And 5 years ago, it was 358. So growth rate was basically found as, because the question is saying that last 5 years growth rate of cash flows revenue is all the same. So you can get the 5-year growth rate. Latest revenue 603. 5 years ago 358. Had it been last year, power 1 upon 1. 2 years ago, power 1 upon 2. 3 years ago, power 1 upon 3. So 5 years ago, power 1 divided by 5 minus 1. Latest over earliest, power 1 upon n minus 1. It's 10.9 and 11%. Okay. Now I've got the FCF, I've got the discount rate, multiply to get value of company less value of debt, value of equity. But there's a small error here, which if you ignore, you might lose marks. According to FCF, value of company is the present value of all future FCF discounted at WACC. Present value of all future FCF. Now, what you have done is you have got this FCF, PBIT, less interest, PBT, then tax, then add back TAD, less investment CA, investment working capital. This is the current FCF. Okay. You need present value of future FCF. So what is happening to the future FCF? It's saying that FCF growth rate is the same, 11%. So I think that future FCF has to be 27.2. Okay. Future FCF 27.2 into 1.11. This is the future FCF. Okay. Then discount rate. That's last discount factor 1 upon KE minus G. Okay. You will get the present value of all future FCF. That's C24 into C25. Okay. Less value of debt. How much is the debt? It's 10%. So value of debt is 10%. So 10% is the value of debt. So value of debt is C26 into 0.1, and you get value of equity 1006.4 minus 100.64. 905.76 is the value of equity, but again, I need to highlight here that this is the value of equity based on current value before IPO. The following information can be used to estimate current value before IPO. So this information needs to be considered to find value before IPO. After IPO, there will be a 30% increase in equity value. So since the question is asking value after IPO, so this C28 when increased by 30%, 1177.49 will be the value after IPO. Now, this thing needs to be paid attention to, that you might be wondering that value under DVM was very easy, right? That present value of all future dividends discounted at K. Yes, it was easy. All future dividends, 1, 2, 3, and 4 is given, then 5 to infinity, 10%, right? It's discounted at K. Present value of all future dividends, the value. To add by shares, value per share. Sorry, total value. And this was before IPO data, after IPO, 30% rise. FCF to company was not very much technical if you understand the information properly. Okay. If the question is asking value of the company under FCF, so it is clearly stated FCF to the firm. So what did first was to write the format of FCF to the firm: revenue, cash cost, TAD, PBIT, interest, PBT, tax, then add back TAD, investment and NC, investment working capital, FCF to company, discount rate WACC, value of company, that is present value of all future FCF, less value of debt, you get value of equity. Okay, after IPO, it will increase by 30%. The thing which needs to be paid attention to that, I always used to prefer to start from PBIT. So start from PBIT. PBIT is 44. How did I get PBIT? You have been PAT to add back interest and tax, 8 and 4. So I reached PBIT. That is 44. No interest in FCF to firm, PBT. Tax paid 20%, add back TAD, investment and NC and working capital was the same. FCF to the company, discount rate WACC. So since not large number of years is given, so last discount factor, that is year 01 upon K minus G, but I cannot multiply. This will lose 1 mark. The whole marks won't be wasted, just 1 mark. Why? Because under FCF, it's the present value of future FCF. So this is current FCF. Future FCF's growth rate is 11% from the last 5-year data, latest over earliest power 1 by 5 minus 1. So this is the future FCF. Okay. You discounted it by WACC to get present value of all future FCF is the value of company, deduct value of debt, value of equity. After IPO, it will increase by 30%. So hope this 5 and 5, 10 marks requirement is clear. Sorry, 10 marks requirement is clear. I have found the value under DVM as well as FCF. Please copy so that we can move forward. Okay. Okay, so I think we should now move towards the next requirements because requirement 8 10 marks are done that based on financial information, you needed to estimate value on dividends and FCF. Dividends was very easy. Present value of all future dividends. Future dividends were given, discounted at K. You get present value of all future dividends. It was before IPO because this was written. The following information shall be used before IPO, right? All this information was before IPO. So I used all the dividends before IPO and got the value. And after IPO, it was increasing by 30%. So I did that. For FCF, I first made the format, and the format of FCF was made as whole format, revenue, cash cost, TAD, PBIT, interest, PBT, tax, add back TAD, investment, NCA, working capital, FCF, discount rate, WACC, present value, and then value of debt, value of equity. So these all things were before. So before it undertakes the IPO, and you were told that starting is the PBIT is the best point. So you have PAT, you added back interest and tax to get PBIT, and then interest doesn't come, PBT, tax, add back TAD, investment, NCA, working capital was same. You get FCF. But under FCF method, present value of future FCF. So you increase it by 11% growth rate. How did you find the growth rate? Latest over earliest power 1 by 5 minus 1 by 5 minus n like dividends. Future FCF discount factor, PV, and less value of debt, value of equity. Okay. Now, what are the other requirements? Comment on the results obtained in Part A and discuss whether using FCF will provide a better estimate instead of using dividends. You need to compare both methods. Comment on the results obtained and discuss whether using FCF will provide better estimate instead of dividends. Okay, which method will provide better results? Okay, so if you do it in pieces, then I think it would be more better. Comment on the results obtained in Part A. Discuss whether FCF will provide a better estimate instead of DVM. Okay, so first comment on the results obtained in Part A. These are the results obtained in Part A, 395 million under DVM and 1177 under FCF. So comment on the results obtained in Part A. So first just comment on the results. The value calculated by DVM is 5 million. I'm writing approximately 395.8. Whereas value under DVM, sorry, FCF is 1177.5 million. Which is approximately 3 times higher than DVM. This is mainly because why this is the case. Because in DVM, you only rely on dividends, which is a very small figure. And on FCF, you rely on cash flows, which is usually a big figure. Okay. This is mainly because DVM relies on dividends while computing value, which is a small figure compared to cash flows of the company. So this is quite routine that you will see value under DVM as being less than FCF because FCF relies on cash flows and DVM relies on dividends. So I think this is the first portion. Comment on the results obtained in Part A. I have commented on the results that the value under DVM is small, under FCF is higher because DVM relies on dividends, FCF relies on cash flows. Now, discuss whether FCF will provide a better estimate instead of DVM. whether FCF will provide a better estimate. Although both methods have some pros and cons, it can be argued that FCF methods still provides a better value compared to DVM because DVM only relies on one single variable, that is dividends, in computing value, whereas FCF method considers range of variables in computing value, right? Although both have some pros and cons, you cannot say that only every method has advantages. There are disadvantages. But remember, FCF method considers multiple variables: revenue, cash cost, TAD, investment in NCA, working capital. Whereas DVM relies on only one single variable. So always this method will provide a better value compared to DVM. Now, if you just end it here, I think it's going to be worth 3 marks maximum. You need to elaborate it more. So what else we can write? Now, this is nothing that you can rote learn from anywhere. This is, you have to create it from your knowledge that you have commented on the results in part A that value of DVM is higher. So FCF is higher than DVM because it relies on dividends, which is small figure, cash flows are big figure. Then the next portion that whether FCF will provide a better estimate instead of dividends. So I said, yes, FCF method relies on multiple variables. DVM only relies on one variable. So it does provide a better valuation compared to DVM. However, both methods have same drawback in case of growth rate, that both keep growth rate as, or both assume growth rate as constant. Similarly, both methods calculate growth rate based on past data and believe same growth will continue in future, which may not be the case. Okay. So you have added one more point that although FCF is better, but they both methods have the same drawback in case of growth rate, that both assume growth rate as constant, and also both calculate growth rate on past data and believe that is likely to continue in the future. Okay, so you can copy this, then I'll move to the part C. Let's move to the next requirement now. Okay, discuss whether Zulla would benefit more from obtaining a listing through a reverse takeover instead of IPO. So discuss whether Zulla would benefit more from obtaining a listing to an RTO instead of an IPO. This is the data. Zulla's CEO has heard that IPOs can place a significant burden on companies. So he has heard that IPOs can place a burden on companies. He has also heard company can effectively obtain the same outcome, but with significantly less burden by undertaking RTO. He has also heard company can obtain same outcome listing, but with significantly less burden by undertaking a reverse takeover. This will involve Zulla taking control of a non-trading listed company. Zulla is unlisted, right? Zulla is an unlisted company. So this will involve taking control of a listed company, and then listed company will acquire Zulla. Hence, Zulla will obtain listing. This is what an RTO is, that you are unlisted. You don't go for an IPO, public offering, and get yourself listed on the stock exchange. You acquire a listed company. And once you acquire a listed company, since you are the in control of that listed company, since Zola acquires a listed company, Zola effectively gets now listed on stock exchange because the listed company will now effectively acquire Zola. So Zola is automatically listed. The CEO is wondering if Zola would benefit from obtaining listing through an RTO instead of IPO. So Zola would benefit from IPO or a listed takeover or takeover, reverse takeover. So discuss whether Zola would benefit more from obtaining a listing through an RTO instead of an IPO. So I need to discuss whether benefit more from RTO or IPO. Okay. An IPO. First, I will write what is IPO and RTO because it's asking which will benefit more from RTO or IPO. A company first shares to public to get listed, whereas in an RTO, an unlisted company acquires a listed company and hence effectively gets listed. You have studied in the classes that when as an unlisted company acquire a listed company. So Zulla acquires a listed company. Okay. Now Zulla acquires a listed company. So Zulla has the control of that listed company. Okay. Then since Zulla has acquired a listed company, the listed company then takes over Zulla. So listed company takes over Zulla. Zulla becomes listed. Okay. This was not the requirement. What is IPO? What is RTO? Okay. I just started my sentence that whether would benefit more from obtaining a listing through an RTO instead of IPO. Okay. An RTO involves significantly lower costs compared to IPO as it does not require financial experts for the process of IPO. Similarly, RTO does not require marketing costs that are usually required for sale of shares in IPO. It RTO is also a quicker way to gain listing as it avoids usual compliance requirements as required in IPO. IPO requires financial experts to make the IPO successful. Okay. RTO, you are just tracking a listed company, so no financial expertise required or less required, cost savings. IPO requires heavy marketing, brochure printing costs. This does not require. Similarly, IPO is a long compliance process. RTO is just not requiring that. Similarly, RTO makes a company gain listing in a shorter time period. So usually RTO is better to gain listing compared to IPO. Okay. Now, what was the requirement? Whether Zulla would benefit more from obtaining a listing through RTO instead of IPO. So I told them what is the difference between IPO and RTO. Okay. Then whether listing is more beneficial through RTO than an IPO. So I wrote RTO involves lower costs, lower financial expertise, lower marketing costs, quicker way, gain listing in a shorter time period. So RTO is a better way to gain listing. Okay. But if I just leave it here, I won't gain any professional marks because I have not applied that skepticism and then two-way and the professional behavior. So you have to always go towards the two-way thing. However, RTO is better. Company may face some hurdles in the sense that market usually perceives RTO as a shortcut, which may be which may create a negative view among investors. This is a drawback of IPO that people consider it as a shortcut. Similarly, RTO requires proper due diligence of the company we are acquiring, as if that company has some problems which are identified later, then it can create reputational loss for the company, right? In RTO, you need to be careful. The company you're acquiring, let's suppose it has some hidden problems. Once you acquire and those problems come later on, you acquired them, now you're a part of them, you face reputational loss. Okay. So any decision about going for IPO or RTO must be taken after proper research and discussion to reach a better decision. Okay. So that's it for 5 marks. You can copy this so that this particular portion gets ended and we can move towards, oh, sorry, this has ended this complete past paper question of September, December 2024. Okay.